Good morning. Good morning. This is Michael Hayes of the Living Legacy Group, welcoming you to a brand new Monday morning. Boy, what a rough night. We are licking our wounds today. I don't know if you're a football fan or not, but maybe we'll do it next time. So, welcome. Thanks again for joining me. If you are new to this platform, please put your name in the comments below. And today we are starting a brand new trading week, and we have been noticing some movement in the coins, getting prepared. We did not make our $1,000 gold yet. We are very close, but we're waiting for some movement on the upside, so we will keep you posted on that. But let's get right into the show. So, yeah, we're back, and I've got to adjust my screen. I did some recording, so bear with me 1 second. If you notice here, the QR code is right here in the center of the screen, so if you'd like to join me and open up your Pocket Options account, that is it right there. We're going to take my head and we're going to move that over. That's not it. Not it. Oops, that's not it. Here it is. Okay, I'm gonna move that over here. Now, hey, welcome back to the channel this week. We're going to pick up where we left off Friday. We were looking at a down market, so it's still, picking up momentum, and it's still things happening with the ETF and blah 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 blah. So let me find some news here. I got the wrong screen here. Oops, I didn't mean to shut that off. Okay, folks, just bear with me for 1 second here, and we're going to pull up coin market cap. We'll slide that right down there and make this on the side. There we go. How was that? Okay. So looking at Bitcoin, we have gone up in the last 7 days, 3.2%. In the last hour, it's been down. So we did come back from that lower range of 38,000, I think it was. Let's see where. Let's see here. Hold on. Changing it over. Changing of the guard. So yeah, so we're we're in our stages. This is a 1 minute chart. Let's go to a daily and see exactly where we're at in the daily chart. It's easier to see that if it was expanded, but since I have the platform set up for this right now, we've come from this area here down to these areas. The lowest low was 38,000. It was challenging because of the fact that there was a lot of reasons behind why the Bitcoin went up, why it went down, what the ETF is, and all that news. You can get it all here at CoinMarketCap. And another site that we do use, that's, hold on one second. Excuse me. One of the links that are in the YouTube description is Cointelegraph. Okay, Cointelegraph is another platform that I do use to help me stay current with all the news that's going on in the industry. I encourage you to seek out more information on this. Matter of fact, let's switch over and let's get a little personal. So, imagine, Bitcoin and other alternative coins as a new type of digital money, like the money we use every day, but online. Now, let's compare them to something familiar. Let's say gold. Gold has been valuable for centuries because of its rareness, and people believe in its worth. Similarly, Bitcoin is like digital gold. It's limited in supply, and more people are starting to believe in the value. So, you know how when we save money, we store it in a piggy bank or a safe place. Well, Bitcoin is stored in something called a blockchain, which is like a super secure digital vault. This makes it, how can I say, it makes it hard for anybody to cheat or steal. Now, I had a lot of questions this weekend, and they were very intriguing because I'm like, yeah, I'm into this, and I want people to be into this. So now let's talk about why some people might, be worried because, excuse me, I was hearing all sorts of things. But just like with anything new, there are some ups and some downs, and people might hear bad news about it, but it's more important to know the whole story. Okay. So think about gold again. Sometimes the value of gold goes up and sometimes it goes down. It's the same with Bitcoin, but here's the exciting part. Many experts believe that, and over time, the value of Bitcoin and other digital coins should go up. To fix that music, kind of staticky. I don't know why it's doing that. And my encoding is wrong again. So, oh well, oh well, oh well. But anyways, like I said, many experts believe in over time the value of Bitcoin and other digital coins could go up a lot, just like gold has increased over its time and value over the years. I'm going to have to turn that off. I can't really concentrate with that. So for some people who are interested in investing, it's like getting into something that could become really valuable in the future. Of course, it's essential to be careful and do your own diligent research, just like when deciding to save money in a special way. So I decided in a quick 5-minute talk, I'd suggest encouraging them to learn more about Bitcoin and alternative coins, understanding the technology behind them, and following reputable sources for news, like the sites that I emphasized before. So, in doing this, firstly, learning about Bitcoin and other digital currencies can be an exciting journey. There are plenty of online resources tailored for beginners, like educational websites, video tutorials, and even online courses. Man, throat. Websites like Coinbase, Binance Academy, and Investopedia offer easy to understand guidelines to break down the basics of cryptocurrencies. It's like having a friendly guide helping you to navigate this through your new landscape. Now, understanding the technology behind Bitcoin may sound complex, but it is not as intimidating as it seems. Think of it as learning how your favorite video game or app works. It becomes more enjoyable when you understand the mechanics behind it. So, blockchain, the technology supporting cryptocurrencies, is just like a super secure digital ledger. Now, exploring these resources like Bitcoin Explained, videos on YouTube, or articles on reputable websites can make this tech talk even more accessible. Now, let's talk about staying up to date. This is so important. Following reputable resources such as news is critical. Think of it like keeping up with the latest trends or news in your favorite hobby. Websites like CoinDesk, Cointelegraph, and the official announcement from well known exchanges are reliable resources. Podcasts and YouTube channels host an industry experts who can also provide valuable insights. So, you ask all this, why bother with this, Mike? You know, all I can say is, man, well, there's such an exciting potential for the long term growth in the world of cryptocurrencies. I don't know. Man, it's like, I hope you can imagine being an early explorer in a new territory. The possibilities are vast. Historically, the values of cryptocurrencies, especially Bitcoin, has been shown an upward trend over the time. It's like planting a seed and watching it grow into a strong tree. However, it is important to be cautious. Cautious is the key. Just as you wouldn't invest in all your money into one stock, diversifying your investments in different cryptocurrencies is a wise move. Treating it like building a sturdy house on a solid foundation is very, very critical. And to have informed decisions in making this your superpower, understanding the risk and the rewards, staying up to date to the market trends, and not letting your emotions, ooh, I'm so good at that, drive your choices are all a part of the game. Remembering it's okay to start small. So I say do the demo thing, like testing. Test the waters before you dive in with me, like I did. So here's the takeaway: learning about Bitcoin and alternative coins is an exciting venture. Okay. Using reliable resources, understanding the technology, stay informed and approach with caution and use strategic mindset. It's your journey beginning your financial empowerment. So take the time to enjoy it. And remember that I'm trying to put the music. I have that. And remember, it's like entering a new adventure. Exciting, but it's important to start to think about it, be smart about it. So please continue to like and subscribe. If you enjoy this content, please share it with your friends. If you know somebody that's already involved into the cryptocurrencies, if it's something that you need their advice or something, reach out to them and ask them how informed they are in the cryptocurrency. While we wait for a little bit, I'm going to put out my sponsored affiliate, PND.
For one thing, very like platform to us here. Even a minute 3 Point Michigan. Open 6 days a week, Monday through Saturday. Give us a call today, 586-777-3801. P&D Uniform.
Back us today and become part of Batch Zero. It is your crypto. Start truly owning what is yours.
You're subject to income tax or capital gains tax, depending on how long you held the asset for. This is where the power of the crypto IRA really shows itself. All transactions made inside of a crypto IRA are tax-free. In addition, unlike when trading on regular exchanges, you don't need to track and report on all of your transactions. Number 2, built-in cold storage security. One of the most important parts of crypto investing is storing the funds securely. If private keys get lost or stolen, those funds are gone forever. If you don't want to deal with having to create private keys, secure them, and manage them yourself, a crypto IRA is a great option for you. At iTrust Capital, we have built-in cold storage security from our partners at Coinbase Custody, the world's most trusted cold storage provider, so you can focus on crypto investing. Number 3, low fees. At iTrust Capital, we have surveyed the entire industry and have made it our mission to have the lowest fees. Other crypto IRA providers will charge up to 12% for you to purchase crypto, including adding hefty monthly fees as well. We charge just 1% per transaction with no sign-up fee and no monthly fees. Number 4, lots of options. Options, and more options. We strive to make sure our clients have access to their favorite cryptocurrencies. Bitcoin, Ethereum, Chainlink, Cardano, Polkadot, and many, many more. You can log into the platform and buy or sell anytime 24/7. We know that the industry moves fast and new exciting projects come out all the time. We're constantly updating our platform to provide a variety of opportunities for you to choose from. Number 5, customer experience. I hate talking to robots on the phone just as much as you do. It just feels like you're stuck in phone jail. We've made it easy for you to get in with our customer experience specialists who help go through the process of setting up your new. In addition, existing clients also have to make sure you always feel taken care of. Tax benefits, cold fee, functions, and a experience are just some of the benefits iTrust Capital clients receive. To learn more, visit itrustcapital.com.
So you can tell it's Monday. Nothing's working, right? but we're trying to pull up our Yahoo Finance. Let's see about where'd the music go? What happened to the music? Okay, we're gonna see if it's still gonna let us play. I don't have Yahoo. All I want is the news. So, good morning. Good morning. Thanks for joining me today. Today is Monday, the 29th of January. And I'm looking for Yahoo Finance right now to put it up on the screen. So let's switch over. See here.
T-Mobile built a 5G network so powerful it goes beyond the expected. And now T-Mobile 5G internet for homes and businesses is here. Just $50 a month with no exploding bills or annual contracts.
Tencent's Riot Games is the latest tech company to announce layoffs. The gaming company is saying it will cut 11% of its staff, or about 530 jobs, as it scales back the division that publishes games from small developers. Now, this move is bringing the total number of employees laid off in 2024 to nearly 11,000. That's according to layoffs.fyi. Joining us now is Roger Lee, the creator of layoffs.fyi. So, Roger, give us a sense of this, because where are we comparatively to 2019 in terms of the hiring and laying off cycle?
So it's been a bad recent few months for tech layoffs. Already this year, we're over 10,000 tech employees cut. And that follows a brutal 2023, where over 260,000 employees got cut in the tech sector, which is the largest year since COVID began in 2020.
Roger, though, how much of this is about a correction that we're seeing within these companies? I mean, when you think about the big tech names that have announced layoffs, so much of that has been followed by the fact that they overhired at the height of the pandemic. How much of what we've seen so far this year can be attributed to that? How much of it is about a broader slowdown that some of these companies are seeing?
So a lot of the recent layoffs are still about tech companies trying to overcorrect for their overhiring during the pandemic, given that
Sorry for the technical difficulties. We're still having a situation with the streaming, I guess. Not the streaming, but a buffering issue. Yahoo Finance.
The high interest rate environment and the tech downturn have both lasted longer than initially expected. Companies like Amazon and Google are finding that maybe they didn't cut enough people in last year's large rounds of layoffs. So they're going back to the well and continuing to implement smaller, targeted additional layoffs.
And of course, we have to talk about the impact of AI. Of course, anytime there's talk about it, you have people shaking their fist at AI, thinking it's going to take their jobs. Obviously, haven't seen that playing out at the moment. But how is that affecting sort of the layoffs and the rehiring that we're seeing of some of this tech talent?
Yeah, even though most of the tech companies are laying off because of broader economic concerns, an increasing number of companies have been citing AI as a reason for layoffs. For example, companies like Dropbox and Meta are both shifting their resources to focus more on AI talent, even as they eliminate jobs elsewhere in their organization.
So what are some of those jobs that are most in demand, given the build out that a lot of these companies are doing on AI?
Well, no surprise, it's everything related to AI engineering. And you're seeing this in tech salary trends as well. According to salary data from comprehensive.io, tech salaries have largely stagnated over the past 2 years. That's no surprise, given that all these layoffs mean that the job market no longer favors employees as much as it once had during the boom times. But that said, AI engineering stands out as the lone exception, where salaries in AI have risen by 12% in a single quarter alone, and have now crossed $200,000 on average for a senior engineer in AI. And that's just cash, including stock. Those compensation packages can be upwards of $1 million.
And so with that in mind then, Roger, how much is there a skills gap versus the demand that we're seeing? I mean, how many of these require, a bachelor's degree or something more advanced versus some of this training that people can do to try and snap up some of these jobs?
Well, the most in-demand roles in AI certainly require a lot of experience and knowledge. So that does have a larger barrier to entry to be able to qualify for some of those most senior, highest paying AI engineering roles. But the good news is that AI is still kind of in its infancy in terms of its long-term potential. So that means it's not too late for folks to be able to get up to speed on how to use AI, how to build for AI. And because with tools like ChatGPT, AI is so accessible, it's fairly easy for even the average person to start playing around with AI and to start figuring out how they can use AI to be productive at their own jobs.
Yeah, Roger, I don't know, that mention of a $1 million compensation package. It's going to get a lot of people thinking about getting into AI. Roger Lee, the creator of layoffs.fyi. It's good to talk to you today. Thanks so much for stopping by.
Thank you for having me.
Salesforce, the latest tech giant to join the list of companies announcing layoffs this year. More than 23,000 tech workers have been laid off thus far in 2024. It's the most since March of 2023. That according to data from layoffs.fyi. Here with what, if anything, this signals for the labor market, we're welcoming in Betsy Stevenson, professor of public policy and economics at the University of Michigan. Betsy, it's great to see you. As we try to sort of decipher where the labor market is now and where it's going, how should we read these public layoff announcements when we're trying to extrapolate what's going on under the surface?
I think it's incredibly difficult to look at a single company or even a handful of companies' layoff notices and draw conclusions about the broader economy. Let's step back and put it in perspective. Every single week, in a booming economy like we've had, roughly 200,000 people lose their job and are able to file for the very first time for unemployment insurance. So the numbers you're talking about are still small and relative to that 200,000. To give you another way to put it in perspective, every month, about 1.5 million people are laid off in the U.S. economy when the U.S. economy is doing well. So in a normal economy, we have a lot of movement. And in fact, that's actually one of the strengths of the US economy, that there are people who get new jobs, there's new opportunities. There's 8 million jobs open right now. So there's a lot of opportunities out there. And then when things aren't working out, when you realize you have too many people, when whatever business you have tried to expand into, it's just not going as well, you cut back. And that's certainly hard on individual people. And I, have, like anyone, empathy for the people who've actually got those pink slips, who lose their job. But it is very difficult to say that this is some kind of warning sign for the economy. in order for us to conclude there's a warning sign, I think we're going to want to see the broader numbers, those aggregate numbers starting to move.
It sounds like, Betsy, I have heard some folks kind of question, they see these headlines, Betsy, about these tech layoffs, and they do wonder whether that's a kind of tell, is that a kind of canary in the coal mine for the broader labor market? It doesn't sound, though, like you see it that way.
For sure, there are people who are like, is this the canary in the coal mine? Should we be looking at this as, more to come? Those initial unemployment insurance claims, they come out every week. So we're not lagging behind in that data. What we saw during the pandemic was the tech sector hired more than anyone else. They really got ahead of their skis. We've already been through, one round of, whoa, the tech sector is laying a bunch of people off. What does this mean for the broader economy? Turned out it meant nothing bad for the broader economy. It meant a healing economy, which was reallocating people away from a bloated tech sector towards sectors that were struggling to hire people who were in demand. I think that's the open question right now. There's still a lot of hiring out there. It's obviously not as booming of a labor market as it was, a year and a half ago. But the question will be, is this tech sector, a canary in the coal mine, or is this more reallocation to places where we need people more than we need them in the tech sector? I think we do still have a healing economy, so I feel very confident that people are going to be reabsorbed into other parts of the labor market. But there is a difference right now. We are in a normalizing, slowing labor market. And for certain people who are experiencing layoffs are not going to find it as easy to get a job that is as well paying or as good as what they had before. And that's going to mean people are feeling some pain.
For more of what we can expect, we want to bring in Brent Thill. He is Jefferies' a senior analyst. Brent, it's always great to get your insight, especially ahead of such a big week here for the tech sector. Heading in to next week, what's the top question you have for some of these tech giants?
Demand environment's number one. AI hype is number two. There's a huge hype cycle we're in, and can these companies deliver on AI? And then I think just sustainability of demand, you've seen tech stocks go straight up. And I think everyone's concerned, is there a little bit of a bubble in terms of overall movement in some of these names? So can the demand hang in, on the backside of this? So I think, those are some big ones at this point. I think that the biggest driver right now is, the AI bubble that we're in. Certainly we believe in it, but as they say, everyone may be overestimating, the near term and underestimating the long term. So I think that's probably the biggest concern, especially for Microsoft, which has been running with all these Copilot AI excitement. Certainly Amazon, can they catch up to Microsoft is another big topic in AI. They've dropped back. We think that they can throughout the year. And then I'd say, for Meta, the biggest thing we're watching is just overall advertising demand has been really coming back, right? We went from a hard landing to the economy to a potential softer landing. And that softer landing is good for advertising. All the Meta checks have been phenomenal, and we've continued to hear great things. I'd say the last thing, we're watching is really these job cuts. And I think everyone in tech that we're talking to is saying that there are more cuts coming. I think many thought these cuts were done. But I do believe there's a lot of excess waste still in the tech ecosystem, and you're going to see probably more job cuts than maybe we would expect. And that goes back to not that demand's bad, but I think that these companies realize that they can do more with less, and that's a good thing into restoring the bottom line health to technology.
Brent, I want to come back to something that you just mentioned a moment ago, in that we could see this bubble burst potentially at some point in the AI hype, and then ultimately the show me story that's started to really formulate at this point. Is there one company that you believe is on watch at this point if that AI bubble does burst?
Well, I think you have to look at the companies where there's the most euphoria around AI, and that's definitely Microsoft, Adobe, and there's a handful of others. Salesforce is probably not as euphoric on AI. But, those are the companies. And we think that, Adobe and Microsoft are in phenomenal positions. The question is, again, and this happened last year with Microsoft, which is, they come out, they show these demos, but then when you talk to the customers in the field, they're like, well, it's not quite as good as they demoed, and the adoption is not quite as fast. And so, look, Microsoft's been guiding to this. They've said front half of the fiscal year, which just ended, no revenue. Back half of this fiscal year, which ends in June, coming up, is when the revenue comes. So we're now expecting this revenue ramp. What kind of details are they going to give us? What kind of color? How are those deployments going to go, right? All of this is talk. The implementation in the field of customers taking it starts to happen now. And I think this is where all the top execs that we know that have been in software for 3 decades, 4 decades in some cases, they're like, everyone's becoming a little skeptical. Like, is this really going to match the hype? And I think in certain cases, like for Microsoft and their Copilot for GitHub, which is their developer solution,
right?
The hype is deserved. But some of the other areas, I'm not convinced yet.
Today, guys, we're starting on a bit of a somber note. So some pretty heavy hitters in the entertainment industry, from traditional media like Paramount Global to some of those publications and newspapers like Sports Illustrated and the LA Times, are going through layoffs, or at least some of these companies hinting that layoffs are going to be coming down the pipeline. And it seems like the reckoning that we saw really throughout 2023 is continuing in 2024. Across the board, a lot of these companies have been trying to right-size their businesses, trying to reduce headcount, reduce the amount of money that they're spending, because at the end of the day, streaming is not still profitable. You have the advertising environment that is just not getting better. That's hammering these cable companies. And in the background of that, you have M&A chatter. So there's a lot of offloading and divesting those non-core assets. And I just wonder what this means as we head deeper into 2024 and really what the future of the industry looks like, because it's certainly going through a big shift.
The ad market comment's interesting because you think about a company like Netflix who has had better margins, and part of what they were able to do was add that ad tier, right? Some of these companies don't fully have that option because they already rely on advertisements a significant amount. I'm thinking of YouTube and I'm thinking of Paramount. They already have arms that build off ads. So it's sort of, where else can you cut costs, because you can't maybe get top line higher, and it comes down to headcount at some point. The other thing, Brooke, is just a lot of these companies are paying a lot for content, right? At some point, if you're paying $1 billion to get NFL Sunday Ticket, you're gonna probably need to cut costs somewhere else, and you probably need Sunday Ticket to get people on the platform. So I get the spend, but obviously that comes with a cost somewhere else.
Yeah, and it seems like that's exactly the narrative across not just the media industry, but really across multiple different sectors. We're talking retail industry like Levi's, tech industry like Salesforce. We're also looking at Microsoft, Wayfair. It's really this reallocation of resources that we're seeing, where they're really prioritizing where the future of the business is going and where employees, different needs, different desires, different skill sets are really needed. And we saw that most recently, like I said, with Levi's, with Microsoft. They did let go, or hint towards letting go, 1,900 Activision, Blizzard, and Xbox employees, really as M&A happens, as they're really looking where they need that skill set. And, it seems like that's going to be a common theme in 2024 as well.
I think, I mean, when you zoom out, think about how quickly we hired after the pandemic, right? You lose, I think it was about 20 million jobs in April 2020 in 1 month alone. And then you have to sort of rehire a lot of these people, not necessarily that they work for the specific companies that were mentioned, but the labor force as a whole, right? And when you're doing that rush to hire, you're overpaying probably, you're trying to train talent quickly, and then I think you pick your head up 2 or 3 years later and you go, okay, who we hire? Who we hire? What divisions did we create? And can AI take some of those jobs or help make them more efficient? There's just a lot of things at play.
I invest in a fund that advances innovations like robotics.
Fresh, warm hot dogs straight out of my torso.
Cool, right?
Anyone can become an agent of innovation with Invesco QQQ. Before investing, carefully read and consider fund investment objectives, risk, charges, expenses, and more in prospectus at Invesco.com.
After the company issued a warning about its 2024 outlook, that weaker than expected guidance weighing on shares just a bit. It's coming off of a mixed report here, and it's just one of several of the big tech reports that we got not only this week, but looking ahead to some of the big tech giants that are going to be reporting over the next trading week. So our 2024 forecast, a bit ambitious. We want to bring in Brian Jacobson. He's Annex Wealth Management's chief economist and strategist to tell us more. It's great to have you here, Brian. So when you take into account the warning almost that we're getting here from Intel, clearly having an impact on some of its rivals this morning in early trading, what do you think that signals then for the rest of this earnings season?
Yeah, it's an interesting earnings season. And if you actually look at analyst expectations coming in, it was a somewhat low bar that was set for the fourth quarter earnings. What I'm a little bit more concerned about, and we here at Annex on our investment committee are concerned about, is the full calendar year 2024 earnings picture. So this time, it's like it was a low bar to somewhat clear. Some are doing it. Some are tripping over that low bar, unfortunately, as you are seeing. It's more or less what's going on with the longer term picture here for 2024. If the consensus is calling for 11 to 12% earnings growth, that seems a little bit aggressive to us here.
What are your clients asking you right now as they're trying to monitor some of these margins that are coming in this earnings season so far and trying to best position their portfolio for that longer term, for that outlook for the full year that you're trying to point the attention to?
Yeah, you know, really last year, if you kind of think about the economic numbers, one of the key words that was oftentimes used to describe the economy was resilience. Mm-hmm. And I think that investors right now are looking for resilient profit growth for 2024 and beyond. So I think that resilience theme is really important. What we oftentimes try to do, though, is not just look at what are profits, but what's the trend for them. And for that, you look at the Magnificent Seven. I mean, a lot of these are real cash cows, right? But they could turn into a messy seven instead, as we've already seen with Tesla, and we'll have to see what happens then with Microsoft and with Apple as well. So it's gone from magnificent to kind of messy. And really where we're finding more opportunities is moving down capitalization. So instead of like the top names in tech, think about more the second tier ones instead, where maybe the valuations are a little bit more attractive and they still do have that resilient profit profile.
Brian, we certainly have seen the expectations for the Fed to cut rates as one of the big drivers here of the recent market gains. When it comes to that PCE print that we got out this morning, the fact that it was a little bit better than anticipated, do you think that keeps the discussion about a potential March rate cut? Is that still on the table?
No, to be perfectly honest, I think that the odds of a March rate cut are effectively zero, mainly because if you look at the data that we've had, inflation is heading in the right direction and growth has stayed rather stubbornly high. Now, what that means is the Fed doesn't have to be in a rush to cut. So absent some sort of additional crisis or something that could emerge, you never know. I mean, that's almost kind of by definition what a crisis would be. It would be a news event, right? It would be new information. The Fed doesn't have to be in a hurry to cut. And I think a lot of people are thinking that for inflation to come lower, we're going to see more material slowing of the economy. But that doesn't really seem to be happening. And so really for us, they might taper their quantitative tightening and then take the next step, which would be a rate cut. But that might be more of a June story.
Brian, thanks so much for joining us here this morning, breaking down all things that investors should keep on their radar as they're monitoring some of the machinations in the economy as well as for their own portfolio. Brian Jacobson, Annex Wealth Management, Chief Economist and Strategist. Thank you.
Got this. Let's go. Gobble, gobble. I've seen bigger legs on a turkey. Rude. Who are you? I'm an investor in a fund that helps advance innovative sports tech, like this smart fitness mirror. I'm also Mr. Leg Day 1989.
Anyone can become an agent of innovation with Invesco QQQ, a fund that gives you access to NASDAQ 100 innovations.
I go through a lot of pants.
Before investing, carefully read and consider fund investment objectives, risk, charges, expenses, and more in prospectus at Invesco.com.
Salesforce, the latest tech giant to announce layoffs. This is according to a report from the Wall Street Journal. Now, the cuts will affect around 700 employees, and it comes just about a year after the company cut about 10% of its workforce in an effort to reduce costs. Now, Salesforce joining a long list of companies that have been forced to make this decision as they look to right-size their workforce. Now, the list including Microsoft, Amazon, and Alphabet. And Brad, more specifically, when you take a look at Salesforce's business, yes, this pales almost in comparison. You never really want to discount any news like this, but just putting it in perspective for our viewers, I think is a better way to put it here. This is 1% of the workforce compared to the cut that we got just about a year ago, which was 10% of the workforce. And since they initially embarked on this cost-cutting journey, we have seen the stock up just about 80% over the past year, far outpacing many of its competitors. So I think the fact that Mark Benioff continuing to make these types of strategic moves that he sees necessary as the company further positions for growth that Benioff has told many times here at Yahoo Finance, just in terms of the optimism and the hype surrounding AI. And we know Benioff is a big believer in that. And he has said it time and time again that it really has the opportunity to boost worker productivity and also revenue by as much as 30%.
Yeah, there are 25 open jobs right now that match specifically artificial intelligence at this company. So you think about where that hiring is actually perhaps even going to backfill some of the jobs that are being cut at this point, as a pivot is clearly in play. We've heard that from multiple companies, whether that be Google, whether that be Microsoft or Amazon, as you were mentioning a moment ago, all of them trying to figure out where they can put the best allocation of headcount and resources towards this next almost cloud-like moment for the industry here. Some have called it the smartphone moment. Okay, that remains to be seen. But if there's anything that we can almost guarantee that artificial intelligence will be in terms of a layer on for these companies, it is similar or analogous to the type of benefit that they saw from cloud, and that's expected. Even when you heard from SAP and some of the restructure that's taking place there, we talked about that earlier this week. Last time I had seen any type of headcount restructuring like that, they were bracing and not even bracing, they were gearing up for the cloud. And so that's the next inflection point, and making sure that they've got people in the right places in order to bring some of these solutions to life in the near term.
Salesforce, the latest tech giant to announce layoffs. This is according to a report from the Wall Street Journal. Now, the cuts will affect around 700 employees, and it comes just about a year after the company cut about 10% of its workforce in an effort to reduce costs. Now, Salesforce joining a long list of companies that have been forced to make this decision as they look to right-size their workforce. Now, the list including Microsoft, Amazon, and Alphabet. And Brad, more specifically, when you take a look at Salesforce's business,
time now for what to watch next week, which could be make or break for the markets. On the earnings front, a huge week for big tech. Microsoft, Alphabet, Apple, Amazon, and Meta all reporting results. Alphabet and Microsoft earnings coming out on Tuesday. As for Microsoft, it comes after announcing layoffs in its gaming division. Apple is reporting on Thursday, trying to reassure investors after a shaky start to the year.
Moving on to the Fed. The Federal Reserve's next meeting starts Tuesday with a rate decision on Wednesday. Now, the market's not expecting any kind of rate cut this month, but still looking toward March for the first rate cut of the year.
And over to the job market, a new JOLTS report for last month from the Bureau of Labor Statistics is out on Tuesday. Job openings taking a dip in November and expecting to drop again in December.
And we'll get the monthly jobs report on Friday. The economy expected to have added 178,000 jobs in January. That would be a decline from December. The unemployment rate expected to tick higher to 3.8%.
Julie, we've got a very busy week next week.
We do.
We do. We got some big tech earnings on deck. Very interested in Apple. Reports on February 1st. Stock is basically flat so far this year. Big questions for Apple investors. How healthy is that iPhone franchise, especially in China, where the economy is weak? You got competition from local rivals like Huawei. What does non-iPhone hardware look like? The watch we know has been making headlines. And of course, services, faster growing, higher margin business. I think investors want to know, does that kind of remain a real growth driver here?
Yeah, there's so many things to choose from. But I thought we had an interesting conversation with Angelo Zeno earlier where he hit on a lot of the tech names. And in Microsoft's case in particular, he talked about three secular growth drivers for the company: cloud, AI, and gaming. Of course, they're just acquiring Activision. And so he seemed pretty optimistic about those three growth drivers. It'll be interesting to see any color we get on things like Copilot, which of course is generative AI powered, and how all of those new Gen AI tools are actually going to flow through to the bottom line. That seems to be what investors want to know for Microsoft. So
for sure. I mean, you look at that stock, so much excitement about how they've been integrating AI across that product portfolio, Bing, Azure, Copilot. So totally agree, that'll be in focus.
Yes, it will. How about Meta, which just made up all of its pre-pandemic losses, right? So, it seems like maybe there's some pretty good expectations baked in there.
Yeah, I mean, listen, as far as Meta is concerned, I mean, if you look at the two best performers since the market lows in October, in terms of the Mag 7, it's of course been NVIDIA, and the other kind of big outperformer has been Meta. And a big reason for that is the valuation. And the valuation to us is still somewhat enticing. We're talking about kind of 19, 20 times on a calendar 25 basis, but on a net cash basis, even more attractive, about 18 and a half times. So our view here is the numbers are going to look very good. It should be another kind of beat and raise quarter, given what we've seen out of the digital ad space here. All eyes, I think, are really going to be on what they have to say on AI and how it's improving their kind of ecosystem, but also in terms of China. When you think about companies like Shein and Temu, they're spending a lot more on Meta's ecosystem as they look to kind of aggressively advertise outside of China because of the slowing market over there. So within the U.S., emerging markets like Brazil, we think is going to be a big theme for Meta in 2024. We think they're going to continue to kind of show those beats and raises in the first half of this year, again, off of some easy comps. And in the second half of the year, you do have kind of a huge election going on, right? So if there are investors out there looking to kind of play the election here, that is potentially a way to do it via Meta.
So finally, while we got you, I want to ask about Microsoft also, just round them all up, right? You mentioned AI, of course, as a factor for Meta. Is AI the factor for Microsoft? Do you think investors are even going to pay attention to the rest of the business, which is still most of the business? And do you think Microsoft is going to have to show some profitability tied to AI?
So when we think about Microsoft, really there are going to be three key secular growth drivers to this company, right? The cloud is one, AI is the other, and then gaming is the other with that recent acquisition of Activision. And we think all three areas are going to show very good prospects here for the December quarter. On the cloud side of things, they pointed towards some deceleration here for the December quarter from the September quarter. Still very healthy, 27 to 28%. If we see a number above that with greater contribution from AI was about 3 percentage points of contribution to cloud growth in the September quarter. If we get something closer to 4 to 5 percentage points, and again, a beat on the cloud side of things, we think that's where the upside potential is and where some excitement grows for Microsoft. And then, of course, what they have to say about Copilot 365, that just launched in November. We think they're going to be very excited about it, but the trajectory of Copilot, of course, is going to be a kind of a huge kind of area of interest out there for investors. So that's what we would be looking at for Microsoft. It is our top play in terms of it being a strong buy, and 12-month target price is $420.
And Angela, I want to get your take on another big name reporting next week, and that's Apple. We had tech investor Dan Niles on the show this week, Angelo. Not a fan of the iPhone maker. And I think Dan's point was basically, the argument he made to us, Angelo, is why am I going to pay about 30 times for this company where the top line performance is just underwhelming? That seemed to be his core argument. What do you think, Angelo?
Yeah, I mean, listen, the reason you're paying high 20s on a 2025 basis for Apple is because of that free cash flow potential, right? I mean, this is a company that we think this year is going to generate about $110 billion in free cash flow, the best free cash flow generator out there on the planet, clearly supporting the buybacks and real stability in that overall business. So, when we kind of think about here the December quarter results, the two key factors you have to look out for is one, the services business. That continues to be the main growth driver for this company. You don't necessarily need to see top line growth or significant top line growth to see the earnings growth for Apple. If you actually kind of look in calendar 2023, you're probably looking at about 8% earnings growth on no revenue growth, right? And that's because of that ongoing mix shift towards the services side of things, which essentially has 2x the margins that hardware does. So we need to continue to see good growth on the services side. And then China is, of course, going to be the other big story out there. If they're showing that China is holding up very well, I think, that's something that kind of alleviates some concerns out there for investors and potentially kind of allows the stock to continue to work here over the next couple of months.
What about, Angela, how much focus are you going to have about what they have to say about the kind of non-iPhone hardware in the quarter, watch, iPad, Mac?
Yeah, I mean, listen, I think as far as those businesses are concerned, the only one that probably will show growth is Max because some of the new products that they rolled out in the easy comps from a year ago. You're probably going to see some sharp declines, specifically on the iPad side of things. They didn't have any new products on that side. And then on the wearable side of things, it really is kind of what they have to say about the Vision Pro. And that has the potential to kind of move a couple of basis points on the wearable side of things here over the next couple of quarters, but we're not expecting much on that side of things. So, I'm not looking too much into those type of end markets right now, but, something that you definitely keep an eye on.
Use it or lose it. At least that's what you're probably thinking about the money in your flexible spending account or your FSA. Now, FSA plans give workers the benefit to save money on health expenses pre-tax, But these accounts do have restrictions and, of course, deadlines. Now, typically, FSA users need to use their money by December 31st, but depending on which healthcare FSA plan you have, your employer can offer you a grace period. And for those who have that extra 2.5-month extension, be mindful that March 15th deadline is just around the corner. Well, joining us now is Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal. So, Lawrence, good to see you again. So give people what they need to know here. How can FSA users best maximize the potential of their account, and what are the deadlines? What should they do between now and the deadlines?
Yeah, it's great to see you as well, Rochelle. And yes, they are in crunch time right now. Essentially, employers can offer typically one of two options. They can either give you the extra 2.5 months, so until March 15th to utilize those funds, or they can also offer you the option to potentially roll over a portion of those unused funds. So if you were left with money and your employer lets you roll it over from 2023 to 2024, you could roll over a maximum of $610. So you're either faced with typically using it by March 15th or rolling over a maximum of $610. So it is important to take a look at those balances from last year and figure out a game plan on how to use what you need to use by the deadline.
And for those, Lawrence, that have some money still left over, I mean, give us a primer here again on what is FSA eligible.
Yeah, so there are thousands of things that are FSA eligible, and with an easy search, you could figure those out. But, let's say you're in a position where you have significant money left over in the account. Think about some of those high price or high ticket items that you might benefit from. So let's say massage can be FSA eligible. That could be a great way to take care of your wellness and utilize some of that FSA money. Maybe you haven't bought yourself a new pair of glasses in a long time, and those can be pricey. Or maybe you need to stock up on contacts for the year. Or maybe you haven't had a dental exam. These are all things that are healthcare related, FSA eligible, and then included, on top of that, there are thousands of products, including, aspirin, Advil, Tylenol, pain products, medicines, things like that are at, your normal, retailers and pharmacies. Many of those are FSA eligible. You could go on and do a search and definitely use those monies very easily.
And Lawrence, sometimes it can be hard when you're sort of picking out your benefits for the year. You see HSA, you see FSA pop up. Talk about the difference between those, and not just what you can spend with them, but also your ability to perhaps borrow against them.
Yeah, so your HSA, first of all, you have to have a high deductible healthcare plan to be eligible for an HSA or a health savings account. So if you have that, it's a way for you to put away pre-tax money that can be used for co-pays, very similar things to an FSA. The benefit of the FSA is you do not need a high deductible savings account. So if your employer offers it, everybody is eligible for an FSA, and it allows you to put monies away pre-tax for very similar things to the HSA, but you also have that use it or lose it functionality in the FSA, or the ability to roll it over from one year to the next, or that extra 2.5 months. The HSA is something that allows you to continue to roll over those monies and grow over time. Neither one of them can you borrow against, but you can use as a vehicle to pay for those out-of-pocket health expenses utilizing pre-tax money.
Lawrence Sprung, Midland Financial, joining us there. Some good takeaways, and author of Financial Planning Made Personal. Thanks so much for joining us today.
Thank you.
I want to actually start, Andrew, on that headline, this decision of the Biden administration to pause approval, Andrew, of LNG exports. And Biden is talking tough here. He says this pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time. So listen, big headline here, Andrew, but really kind of bottom line this for us. What does this actually mean, Andrew? What kind of impact does this actually have?
Well, thanks very much for having me. In the near term, the impact is very limited. We actually have 3 large LNG export facilities that are coming on stream in the next 12 to 18 months on the Gulf Coast, which will make the U.S. an even bigger LNG exporter. What these new rules do is delay these several projects that were underway looking for their final permits so they could go ahead with the construction, but those plants wouldn't be coming on stream until 2027 or beyond. I think in the context of world energy supply, we have Russia's invasion of the Ukraine resulted in Europe really eliminating the majority of its natural gas imports from Russia. They've been turning to the United States and other suppliers to fill in that gap. And that's where I see the biggest issue going forward.
Hey, Andy, it's Julie here. Are we going to see some of the LNG producers and exporters in the U.S.? Are there any kind of measures they can take to, say, offset emissions that then would satisfy the administration?
Well, I think one of the biggest things that producers look at here in the United States is this carbon capture and sequestration, meaning that as they produce the oil, especially if the natural gas is being burnt off into the atmosphere, to put that back and re-inject it into the ground, or any of their carbon dioxide emissions need to be re-injected into the ground to lower what we call their carbon intensity.
And Andrew, I want to switch gears a bit. Let's talk about oil. I'm looking at Brent here at 78. Where do you see that price headed, Andrew, in kind of just the near to intermediate term here?
Well, today we had an event in the Red Sea where a missile struck an oil tanker that was on its way from the Mediterranean to Singapore, and that caused the oil market to completely turn around. We were down $1 this morning. We're up about 70 cents this afternoon. And these geopolitical tensions in the Middle East are causing the oil market to price in a higher probability of a supply disruption. So as a result, I'm expecting that we could see $80 WTI here in the next couple of weeks. And that, of course, translates into higher gasoline and diesel prices for the consumer.
T-Mobile built a 5G network so powerful it goes beyond the expected. And now T-Mobile 5G internet for homes and businesses is here. Just $50 a month with no exploding bills or annual contracts.
Time now for what to watch next week, which could be make or break for the markets. On the earnings front, a huge week for big tech. Microsoft, Alphabet, Apple, Amazon, and Meta all reporting results. Alphabet and Microsoft earnings coming out on Tuesday. As for Microsoft, it comes after announcing layoffs in its gaming division. Apple is reporting on Thursday, trying to reassure investors after a shaky start to the year.
Moving on to the Fed. The Federal Reserve's next meeting starts Tuesday with a rate decision on Wednesday. Now, the market's not expecting any kind of rate cut this month, but still looking toward March for the first rate cut of the year.
And over to the job market, a new JOLTS report for last month from the Bureau of Labor Statistics is out on Tuesday. Job openings taking a dip in November and expecting to drop again in December.
And we'll get the monthly jobs report on Friday. The economy expected to have added 178,000 jobs in January. That would be a decline from December. The unemployment rate expected to tick higher to 3.8%.
Julie, we've got a very busy week next week.
We do.
We do. We got some big tech earnings on deck. Very interested in Apple. Reports on February 1st. Stock is basically flat so far this year. Big questions for Apple investors. How healthy is that iPhone franchise, especially in China, where the economy is weak? You got competition from local rivals like Huawei. What does non-iPhone hardware look like? The watch we know has been making headlines. And of course, services, faster growing, higher margin business. I think investors want to know, does that kind of remain a real growth driver here?
Yeah, there's so many things to choose from. But I thought we had an interesting conversation with Angelo Zeno earlier where he hit on a lot of the tech names. And in Microsoft's case in particular, he talked about three secular growth drivers for the company: cloud, AI, and gaming. Of course, they're just acquiring Activision. And so he seemed pretty optimistic about those three growth drivers. It'll be interesting to see any color we get on things like Copilot, which of course is generative AI powered and how all of those new Gen AI tools are actually going to flow through to the bottom line. That seems to be what investors want to know for Microsoft. So
for sure. I mean, you look at that stock, so much excitement about how they've been integrating AI across the product portfolio, Bing, Azure, Copilot. So totally agree that'll be in focus.
Yes, it will. Salesforce, the latest tech giant to join the list of companies announcing layoffs this year. More than 23,000 tech workers have been laid off thus far in 2024. It's the most since March of 2023. That according to data from layoffs.fyi. Here with what, if anything, this signals for the labor market. We're welcoming in Betsy Stevenson, professor of public policy and economics at the University of Michigan. Betsy, it's great to see you. As we try to sort of decipher where the labor market is now and where it's going, how should we read these public layoff announcements when we're trying to extrapolate what's going on under the surface?
You know, I think it's incredibly difficult to look at a single company or even a handful of companies' layoff notices and draw conclusions about the broader economy. Let's step back and put it in perspective. Every single week, in a booming economy like we've had, roughly 200,000 people lose their job and are able to file for the very first time for unemployment insurance. So the numbers you're talking about are still small and relative to that 200,000. To give you another way to put it in perspective, every month, about 1.5 million people are laid off in the U.S. economy when the U.S. economy is doing well. So in a normal economy, we have a lot of movement. And in fact, that's actually one of the strengths of the US economy, that there are people who get new jobs, there's new opportunities. You know, there's 8 million jobs open right now. So there's a lot of opportunities out there. And then when things aren't working out, when you realize you have too many people, when whatever business you have tried to expand into, it's just not going as well, you cut back. And that's certainly hard on individual people. And I have, like anyone, empathy for the people who've actually got those pink slips, who lose their job. But it is very difficult to say that this is some kind of warning sign for the economy. In order for us to conclude there's a warning sign, I think we're going to want to see the broader numbers, those aggregate numbers, starting to move.
It sounds like, Betsy, I have heard some folks kind of question. They see these headlines, Betsy, about these tech layoffs, and they do wonder whether that's a kind of tell. Is that a kind of canary in the coal mine for the broader labor market? It doesn't sound, though, like you see it that way.
For sure, there are people who are like, is this the canary in the coal mine? Should we be looking at this as, more to come? Those initial unemployment insurance claims, they come out every week. So we're not lagging behind in that data. What we saw during the pandemic was the tech sector hired more than anyone else. They really got ahead of their skis. We've already been through, one round of, whoa, the tech sector is laying a bunch of people off. What does this mean for the broader economy? Turned out it meant nothing bad for the broader economy. It meant a healing economy, which was reallocating people away from a bloated tech sector towards sectors that were struggling to hire people who were in demand. I think that's the open question right now. There's still a lot of hiring out there. It's obviously not as booming of a labor market as it was, a year and a half ago. But the question will be, is this tech sector, a canary in the coal mine, or is this more reallocation to places where we need people more than we need them in the tech sector? I think we do still have a healing economy, so I feel very confident that people are going to be reabsorbed into other parts of the labor market. But there is a difference right now. We are in a normalizing, slowing labor market. And for certain, people who are experiencing layoffs are not going to find it as easy to get a job that is as well paying or as good as what they had before. And that's going to mean people are feeling some pain.
Pensions are back. Sort of. IBM is saying goodbye to its 401k. Instead, employees will now have access to a plan reminiscent of an old school pension. Here to break down the details is Yahoo Finance's Carrie Hannon. Carrie.
Well, yeah, this has sort of had the retirement industry a buzz for a while now. And starting in January, IBM kicked off this new option. Now, it's not getting rid of their 401k, but what they are doing is instead of the employer match to the 5% employer match, they're taking that 5% and putting it into what's like a cash balance account. And so you can continue to contribute to a 401k if you're already there. But what this benefit does is that it allows you, they're going to take that 5%. If you've been there for a year, they'll take 5% of your salary, put it in this account, and you don't have to make any investment decisions. And when you choose to leave, you can take it with you. It's portable. You can take a lump sum, or you can have it moved into an annuity that will pay you out a benefit for the rest of your life. This is kind of a really interesting option to shift back to. They're guaranteeing, I think, for the first 3 years, the 6% return, and then it will be tied to the 10-year Treasury. But what's interesting is it's trying to solve a problem where people are panicked about will they outlive their money, and they yearn for those days of pensions where only about 11% of private employers plans have a pension option, but they want somebody that they know they're going to have some kind of income stream. So this is kind of a big deal in the industry. I don't know how much more of this we're going to see, but I do think it's a movement to pay attention to people who have that inertia about starting to save for retirement. And more retirees than ever more individuals are turning 65 this year than ever before in history. So we're going to see more people retiring. And these kinds of lifetime annuities perhaps will be a version of this. But guaranteed income is starting to edge back into the retirement scenario. So stay tuned.
Today, guys, we're starting on a bit of a somber note. We're talking layoffs of some pretty heavy hitters in the entertainment industry, from traditional media like Paramount Global to some of those publications and newspapers like Sports Illustrated and the LA Times are going through layoffs, or at least some of these companies hinting that layoffs are going to be coming down the pipeline. And it seems like the reckoning that we saw really throughout 2023 is continuing in 2024. Across the board, a lot of these companies have been trying to right-size their businesses, trying to reduce headcount, reduce the amount of money that they're spending, because at the end of the day, streaming is not still profitable. You have the advertising environment that is just not getting better. That's hammering these cable companies. And in the background of that, you have M&A chatter. So there's a lot of offloading and divesting those non-core assets. And I just wonder what this means as we head deeper into 2024 and really what the future of the industry looks like, because it's certainly going through a big shift.
The ad market comment's interesting because you think about a company like Netflix who has had better margins, and part of what they were able to do was add that ad tier, right? Some of these companies don't fully have that option because they already rely on advertisements a significant amount. I'm thinking of YouTube and I'm thinking of Paramount. They already have arms that build off ads. So it's sort of where else can you cut costs, because you can't maybe get top line higher, and it comes down to headcount at some point. The other thing, Brooke, is just a lot of these companies are paying a lot for content, right? At some point, if you're paying $1 billion to get NFL Sunday Ticket, you're going to probably need to cut costs somewhere else, and you probably need Sunday Ticket to get people on the platform. So I get the spend, but obviously that comes with a cost somewhere else.
Yeah, and it seems like that's exactly the narrative across not just the media industry, but really across multiple different sectors. We're talking retail industry like Levi's, tech industry like Salesforce. We're also looking at Microsoft, Wayfair. It's really this reallocation of resources that we're seeing, where they're really prioritizing where the future of the business is going and where employees, different needs, different desires, different skill sets are really needed. And we saw that most recently, like I said, with Levi's, with Microsoft. They did let go, or hint towards letting go, 1,900 Activision, Blizzard, and Xbox employees, really as M&A happens, as they're really looking where they need that skill set. And, you know, it seems like that's going to be a common theme in 2024 as well.
I think, yeah. I mean, when you zoom out, think about how quickly we hired after the pandemic, right? You lose, I think it was about 20 million jobs in April 2020 in 1 month alone. And then you have to sort of rehire a lot of these people, not necessarily that they work for the specific companies that were mentioned, but the labor force as a whole, right? And when you're doing that rush to hire, you're overpaying probably, you're trying to train talent quickly, and then I think you pick your head up 2 or 3 years later and you go, okay, who we hire? Who we hire? What divisions did we create? And can AI take some of those jobs or help make them more efficient? There's just a lot of things at play.
The S&P 500 snapping its record run here, but it was still a winning week. Yahoo Finance's Jared Blicker is here with the recap. Jared.
Dow record, that counts, right? Well, we also have some green for the day, but importantly, the major indices are in the green for the week, and this is now 12 out of the last 13 weeks. Just an incredible bull run here. And let's take a look at some of the individual stocks contributing to this list of record highs. We have a new entrant, American Express, up 7% today off of earnings. Haven't seen that on the record high list for nearly 2 years. You have to go back to February of 2022. Also, Berkshire Hathaway, a recent entry, that's up 1%. Meta, Alphabet, you know the list here. TJX and Ross Stores, so some retail names in there. Hilton, you got travel. Aflac, you got insurance. Boston Scientific, you got pharmaceuticals. So a broad swath here that we're looking at. And let's take a look at the sector action for today and also for the week. Energy, the big winner on both fronts. That's up 0.75%. We are actually just seeing some headlines roll in from the Middle East where there was a missile apparently fired at a vessel and it is now on fire near Yemen. We're going to talk about that with an oil guest shortly. But for the week, let's check out the 5-day totals. We haven't seen XLE with a gain like this in 1 week in quite some time. It's been a laggard recently, so that's significant. Communication services, that's up 3.8%. That's Alphabet, Meta. Netflix was a big component of that gain this week. XLF is financials. All three of those outperforming. To the downside, consumer discretionary down 1.8%. That is a Tesla story. We're going to see that in a second. Real estate and healthcare also in the green. And here's a look at the NASDAQ 100. We do see Tesla. Well, that is a standout there. That's down 13.6%. Worst week in a long time. Intel also the worst week since last year, but some decent gains by the mega caps and the Mag 7. Once again, Alphabet up 4%, Amazon up 2.4%. So another week of records.
Tesla recalling nearly 200,000 cars. That's due to a software instability issue, closing out what's been a roller coaster week for the company. JP Morgan, by the way, also slashing its price target on that stock after the automaker reported softer than expected earnings for the 6th straight quarter. So this one, Julie, we did hear from Dan Ives over at Wedbush today. Interesting note. Now, Mr. Ives, still bullish, outperformed, targets 315, but he was, in his words, massively disappointed with that conference call. Here's what he told his clients this morning. Here is what Musk needs to do. You want to hear what Dan Ives
Yes,
Here it is. Yes. One, he says, let's get some capital return going. You got to announce a $10 billion buyback. He says gives Musk more control. Remember, there's this drama playing out. Musk says, listen, I want control, or I might just take my AI and robotics projects, Julie. I might take them someplace else. I will pick up these marbles and I will go to a different game. And stop the price cuts, he says. Maintain margin leverage over all the other auto players. So that was the Dan Ives playbook for Mr. Musk.
Well, if Musk listened to Ives or anyone except the voices in his head, that would be a first. So we'll see if he does make any of these changes here. Just a couple superlatives for you as we look at the Tesla performance on the week here. Tesla on track for its worst week since the one that ended October 20th, which incidentally, it also reported earnings. So in other words, it fell after that last earnings report, fell after this earnings report. It's now down 26.5% year to date or so, at the lowest price since May. And it looks like we are now looking at the 6th straight weekly decline for those Tesla shares. There's a lot of discussion here about how long these doldrums for Tesla might last, or whether the stock is nearing a bottom now and then could reset. You know, I think time will tell. We do know that after the close yesterday, we learned that Cathie Wood's ARK had come in and bought some Tesla here. In fact, almost 178,000 shares of Tesla. Last year, we saw her kind of get in and out of the stock a little bit, not out entirely, but add and subtract a little bit from Tesla. So, you know, we'll see if some other bulls who are devoted end up getting in.
It's just, you know, after that print and after that call, you just had so much uncertainty still.
Yeah.
You know, I mean, one is just kind of big picture uncertainty. Where is EV demand exactly? I mean, it's certainly slowing here, and the price cuts that Dan Ives is talking about, and the margin trajectory, and then of course competition. with Chinese rivals, the BYDs of the world.
Yeah, a lot of questions remain. Let's get to another mover on the day. Health services provider BrightSpring, which went public today. The company opening below its $13 offer price, and it didn't get back up there. So the shares finishing lower by 15%. The company raising almost $693 million in that IPO, but it did price the shares at below the expected range. It is backed by KKR, by the way. So everybody's looking at the IPO market this year. We've been talking to guests about it. They're hoping that things are going to open back up. This is not a very good omen.
No, it's fun. You're right. So this biggest kind of conversation, kind of this trickle last fall, the ARM, right? Yeah. Instacart. We actually remember just this week we talked to John Keaton over at Torch Capital. We asked John, do you think it's is the trickle going to turn into a stream? He was like, no, it's going to be a trickle. Yeah. At least the first half, in part because he said just too much uncertainty still and questions about the economy, and in part it was interesting, he said, because the reception that these folks are getting has not been encouraging.
Right, and this is not like a buzzy tech startup, right? This is a community-based health provider backed by KKR. Right. So it's not like that this one had the most hype surrounding it. But still, folks who are looking for that IPO market opening cannot be too overjoyed with this kind of result.
Sure. All right, fine. Let's take a look at Colgate-Palmolive shares. They're rising after being on the top and bottom line. Nice pop in today's trade. Company expecting organic sales growth to be within its long-term target range of 3% to 5%. So let's talk household products, Julie, just for a hot second.
Let's do it.
The stock did hit a 52-week high in today's trade. And just kind of looking at the results, it was interesting. The Q4 adjusted earnings beat. It looks like sales clocked in at $4.95 billion. That was also a beat. It looks like the Latin America division, that was one real standout in the print. Stocks up about 10% now over the past 12 months.
Yeah, oral care also doing well. The classic toothpaste stuff that Colgate-Palmolive makes. I mean, a lot of the commentary I'm seeing around the earnings is like, okay, this was good. It was, it wasn't fantastic. One analyst at Wells Fargo said it checked the boxes, the numbers, right? So it's not like an enormous amount of enthusiasm here, but just nothing that really raised alarm bells. The company for the full year says organic sales growth is going to be 3 to 5%, which leaves it a little bit of room potentially to beat analyst estimates.
Yeah, team at Evercore. Now they do like this name. Their client, their price target's 90. They like what they say is a high quality beat, meaning EPS and margins beat despite kind of reinvestment in advertising. They call that oral care, Latin America, and North America, where volume stabilized, Julie.
Yeah, that's what analysts investors want to see right now. Volumes looking better.
For sure. I'm interested, Jay. The Fed is expected to cut rates this year, and I would think, Jay, that's a pretty great bullish tailwind for this sector, just in terms of lifting sales and margins. Bills can reduce the incentives. So is your point just simply, okay, that's a tailwind, but it's just simply priced in at these levels?
Yeah, I think that's part of it. I think the other side of it is that even though there is the potential for rate cuts out there, in terms of the actual effect on the 30-year mortgage rate, the 30-year mortgage rate has only come down, as of where the numbers are today, only about 100 bips. So homes are slightly more affordable than they were, but much more expensive than they were, say, a year ago or even 2 years ago. And we feel like with, again, the move this group has had, we've priced in a lot of that good news. And if we do see, and I think probably the risk to our more cautious view is that if mortgage rates do finally start to come down at some point, that will pull more people back in, potentially could make our numbers be a little conservative. But right now, with mortgage rates kind of stuck at 7%, just don't see a reason to get overly bullish on the space at this point.
That said, there are some names that you like within home builders, and one of them is one that I wasn't as familiar with, and as you point out, it's not as popular. It's a company called Cavco that does factory-made housing. Why is that one more attractive?
So Cavco is a name that sells affordably priced homes. According to the Manufactured Housing Institute, the average price of a single section home was $70,000 last year, in 22, and $210,000 for a double section home. You compare that to where existing home prices are on a median basis at almost $330,000 in the U.S. This Cavco is a name that sells a very affordable payment, which is what the manufactured housing buyer is typically looking for. We also think the balance sheet of this company, which is all a net cash balance sheet, significantly net cash balance sheet, gives them the staying power to weather some of the mortgage rate fluctuations that the manufactured housing market saw in 23, just like the site-built housing market saw.
I'm interested, Jay, when you look at these home builders, just as companies, have they become more efficient, Jay, in the last few years? Do their business models look different?
Yeah, I think so, and especially if you think about the enhancements that they've made to their websites. 85% of home searches start online now, and the builders, even before COVID, but especially as COVID took off, the builders made a lot of enhancements to their website. You can plan out a lot more things. You can get a visualization of what your home might look like on a given lot inside of a subdivision. So I think for the Gen Zs and the millennials who are solidly in household formation years, having those tools for digitally native buyers.
Names, because we are starting to see a bifurcation in the performance of these top 7 names. It started with that miss from Tesla last week. They are actually the biggest gainer, though, in today's trade when it comes to the Magnificent Seven. But it leads to this broader question that I've been having. When you expect 20% growth constantly from these Magnificent Seven names, and they're not able to on that, it causes this multiple compression, and that's what we're seeing in some of these names, particularly with Tesla last week. We're seeing NVIDIA, Meta, Apple, and Alphabet in the red today. The other 3 in the Magnificent Seven are in the green. But I want to look also at the S&P equal weight versus S&P cap weighted index, because everyone's been saying, JP Morgan reiterating this morning, that if you want to take on a little bit of risk, you can get it in the S&P equal weighted index. But we're seeing that has given back all of the gains that it had over the cap weighted index since November, and that is an indication that these tech names that we're going to hear more from this week, continue to drive this market.
Certainly is, Maddie. We've been talking about that all morning. We're looking forward to those results here, and they all start tomorrow, actually. So certainly a massive week here for investors. Madison, thanks so much. Let's kick it over to Jared Blicker with a closer look at some of the movement that we're seeing across.
And we're not seeing too much movement in the indices. The Russell 2000 is in the indices. The Russell 2000, the small caps, just slightly in the green. The other 3 major, they are in the green. Let's take a look at the sector action first. We got consumer discretionary and tech. Those are each up 0.25% in the early going, performing the S&P 500. To the downside, energy taking the rear spot, the caboose down about 0.6%. Communication services also looking a little bit weak. Here's the NASDAQ 100. So mixed picture with respect to the mega caps there. Not seeing a whole lot of outsized movement. Let me just take this opportunity to get to the S&P 500. And a bigger picture view. This is the ICE B of A Move Index. Let's get to B of A Move Index. Let's get to the S&P 500. Index. This has dropped to a multi-month low. You can't necessarily see it right here. There you go. Got that little print. This is good for stocks overall, and especially the growth stocks. So this is potentially another tailwind for stocks as we head into a very potentially volatile week, guys.
Yeah, big week.
Volatile week, guys.
Yeah, big week. A lot of earnings and economic data that the markets are going to be digesting. Jared, thanks so much for teeing up today's trading activity for us. Well, Stifel, TD, Cowen, and Morgan Stanley all getting off the Norfolk Southern train. The three firms, they're issuing separate downgrades on the rail company this week. Both TD and Stifel saying they don't expect margin improvement this year, and all three say NSC is trailing its competitors. This comes after the company cut 7% of its management and staff last week. We were tracking shares of NSC. They are down by about 1.3% right now.
Yeah, certainly, Brett. And I think this just points to the fact that Norfolk Southern is going to have a challenging several months and several years potentially ahead of them. And that was my takeaway from these three notes, and also really follows what we heard from Norfolk Southern when they did report that week of guidance here. They are still clearly suffering from that derailment just about a year ago. Now they have invested heavily in safety. They've invested heavily in tech in order to hopefully in the future avoid these types of situations, but it is still reflected in the costs that continue to grow here for this company. Their profit falling over 30%, and TD Cowen really making the case that this is a name that will likely, because of all that, continue to lag many of its peers here for the next 2 to 3 years as they do try to right the ship a little bit.
Yeah, part of the righting the ship effort is going to have to move through some of the dicey situations that are on the East Coast that Stifel points out. The outlook for ports on the East Coast in 2024, murky, they say. Disruptions in Panama Canal and the Red Sea that could be further heightened by a looming dock worker strike. So that on the docket here, and Norfolk Southern specifically, for them, these disruptions, Stifel says, could have far-reaching impacts. Of the peer group, the most intermodal exposure this company has, representing over half their total volumes right now.
All right, well, let's move on to a big story that investors, Americans are clearly going to be tracking over the next several months, and that is the 2024 presidential election. It is a key focus for investors, with a Trump versus Biden rematch seeming more and more likely. But what does either outcome signal for the global markets? We want to bring in Peter Oppenheimer. He's Goldman Sachs global equity strategist and head of macro research in Europe. And we're also joined by Yahoo Finance's executive editor, Brian Size. Great to have both of you. Let's talk about what exactly this election could potentially mean here for the markets, Peter. And I think more broadly speaking, is Trump or Biden, is one candidate viewed as a better alternative here for stocks?
Well, I think the first thing, and thank you for having me, is to say that, of course, we have a lot of elections this year around the globe, the most important one being the US. And one thing that's interesting, despite the potential volatility that could bring, is that implied volatility in the equity market is really very low at the moment, to the point that you mentioned in your earlier remarks. So I do think that we are likely to see more volatility in equity markets as we move through the year and the elections, and particularly in the US, become more relevant. And obviously, the US election will have a big impact on the global economy, in particular because of its impact on possible trade policy. The potential Trump administration bringing blanket tariffs across the board of products brought into the US would have a much bigger negative impact outside of the US, of course, than in the US itself. Likely you'll get fiscal contraction under either outcome, because on regionalization and building up manufacturing again in the US, which might be supportive for US companies, but again, less so for companies trying to sell into the US market.
Peter, what would you say is the current status of kind of international trade, where the U.S. needs in those next 4 years of any term to position itself? And of the two candidates, where do you see actual movement forward?
Well, I think this is, I don't think there's a very big difference on this regard with either candidates. I think the general pattern here is one where the globalized process of world trade that was really the dominant driver in the last 15 or 20 years is beginning to reverse to some degree. And this is reflecting the rise in geopolitical tensions, also the realization after the pandemic that complex globalized supply chains may be less reliable moving forwards. And in addition to that, things like decarbonization is forcing more focus on regional or domestic production. So I think under either circumstances, it's likely that we're moving into an environment where there's less expansion of world trade. And therefore, it really matters a lot what the domestic growth rates are in these different parts of the world.
And Peter, against this backdrop, you're out with a new book. Congrats on that. I believe that is your second book. Congrats on that one. And to me, the vibe, just reading it, Are There Any Happy Returns is in fact the name of that book. The vibe for me is that investors should almost get outside of perhaps this focus on politics and maybe interest rates and really lock in on what you're calling super cycles. So what super cycle do you see emerging? Over the next decade, and how do investors make money on it?
Well, thank you for emphasizing the book. Yes, what it really is saying is that investors should perhaps focus less on what's urgent, like the near-term prospects of inflation or interest rates, and that really is the cycle, and indeed is moving in a positive direction as we expect inflation to come down and interest rates to follow this year, and really focus more on the important longer-term structural issues which create these super cycles. And there are some challenges, I think, that we have to look forward to. One of them we've just been discussing: less globalization, more regionalization, more repetition of supply chains. That means higher costs and less margins for businesses. We're also in an environment where we're not likely to see interest rates trending downwards consistently over the next few years, as we've seen in the last decade or two. And that means probably a higher cost of capital and lower returns. But at the same time, there's some very exciting developments to focus on as well. The combination of the impact of things like AI on the one hand, which ultimately could boost productivity, and at the same time, the significant changes that are likely to emerge as we move towards a more decarbonized, greener energy policy. And that's going to create a lot more jobs through more investment in clean technologies and clean energy.
And Peter, digging a little bit deeper here into the technology and AI point that you were just discussing, I think more specifically, how do you see that impacting returns here going forward? Maybe not so much in the next 2 to 3 years, but more so on a longer term timeline. And when it comes to what investors should do then to best prep their portfolios or position them for that, what would your advice be that investors should consider today?
Well, I think both of these factors are going to be very important drivers of the global economy in the next decade. Insofar as AI is concerned, on the negative side, you've got the prospect of some job displacement. I mean, after all, AI, ultimately, if it's going to boost productivity, will do so by taking some jobs. But the positives are that I think it will boost productivity, and you'll start to see companies outside of the technology sector starting to leverage and employ these technologies to become more efficient and create stronger growth. There are many sectors where this could have a positive impact. Healthcare is a very good example, where large data analysis can help to speed up drug discovery. In terms of decarbonization, the cost here, or the near-term constraints, are really how much it's going to cost to reconfigure our economies and to build the necessary renewable networks and infrastructure and the investment to improve environmental technology. But again, the longer term benefits will be that the marginal cost of energy will come down significantly. So I think investors should look at both of those areas as broadening out the possibilities for companies that can work towards utilizing these drivers, who can help facilitate the move towards a decarbonized economy because they're likely to see stronger long-term growth, and what companies can really utilize new technologies and things like AI to become more efficient, to create new products and services. And those are two areas that we're very focused on.
Some really valuable insights there. Peter Oppenheimer, Goldman Sachs global equity strategist and head of macro research in Europe, alongside Yahoo Finance's executive editor, Brian Sozzi. Thank you both.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Now made from Daya Oat Cream Blend. Daya, dairy-free dairy.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Further fallout for Boeing this morning. The Alaska Airlines 737 MAX 9 jet, which had its door plug blowout mid-flight just over 3 weeks ago, appears to have left Boeing's factory with bolts missing. That's according to the Wall Street Journal. Now, airlines are dealing with the ramifications of the incident, including delivery delays. Boeing has halted production expansion for the 737 MAX 9, and United is now reportedly in talks with Airbus about purchasing jets, which could replace an existing order of Boeing 737 MAX 10 jets. For more on the fallout, we have Connor Cunningham, Melius Research Director. Connor, great to have you here with us this morning on this matter. How perhaps
to kind of outgrow their cost structures. Now there's been a lot of cost convergence out there as growth has slowed. So the growth has slowed. So what is JetBlue going to have to do? Well, what is JetBlue going to have to do? Going forward to survive. So we'll see how that plays out in the weeks to come. See how that plays out in the weeks to come.
Do you think Frontier is still somewhere out there waiting in the wings?
Maybe. It's certainly, they were the ones that wanted to do the transaction to begin with. They're probably not rushing to do something right now. Definitely looking at kind of what Spirit's going to look like standalone. My guess is that they're in no rush, but again, the people that are behind Frontier, have historically been behind Spirit as well with the Indigo partner, private equity guys. So we'll see how it all plays out, but they definitely could swoop in. That transaction to us makes a lot more sense than the JetBlue Spirit one did. Again, models are very similar from what they're trying to accomplish. Again, it's all about growth and being able to kind of push growth at potentially lower prices relative to the industry as a whole. So we'll see how it plays out. Definitely something that could happen though in our view.
Let's talk cruise lines really quickly. You cover Royal Caribbean, and I bring that up because there's lots of talk this morning about Icon of the Seas, the largest cruise ship. I know you attended the launch event. My question to you, though, is this going to be the trick or the ticket here for cruise lines to get more people to board these cruises?
Yeah. So yeah, we did attend that. The Icon of the Seas event. It was quite something. Again, that ship is obviously very nice and huge. The one thing that from our standpoint is that it's a really niche industry at the end of the day. There's about 30 million people that travel on cruise ships. So they're all about not necessarily fighting. Ships like the Icon of the Seas should bring a lot of optionality for people. You attach that to a potential, a day at Coco Cay. It's a pretty nice vacation, and it hits a lot of it checks a lot of the boxes that I think people want to go on. My kids loved it, so it's obviously very family friendly. Type of vacation.
Looks like there's a heck of a lot of activities on that ship. I think any kid would absolutely love being on that. All right. Conor Cunningham, great to have you. Thanks so much for joining us here this morning.
Thank you.
All right, we've got much more market action ahead, and we will take a look at what's happening in the discount retailer space, and no doubt from JP Morgan. More on that when we come back.
Now made from Daya Oat Cream Blend. Daya. Dairy-free dairy.
For new businesses, Fiverr Freelancers is like a backbone. You can find anything. My name is Jimmy Valentin, and I'm the founder of Jupiter Talents. I've seen musicians do the talents. I've seen musicians go through a lot, and this app will really help them. Working with Fiverr, it was pretty easy. All I did was log on. I went on search, I typed in app development. I found freelancers. I picked the one that would fit my budget and the one that had great reviews. I got exactly what I wanted with just one click. Join Fiverr today and get something going.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time. From Yahoo, cancel on time from Yahoo Mail.
JP Morgan upgrading Dollar Tree. The firm seeing investor opportunity in the space. We dive into a few things here, and as are some of the exposed areas as a result of what's taking place in the Red Sea right now. And so that was the categories that they were looking across, but specifically as it relates to discretionary spending, they note by banner, Dollar Tree's mix is 51% discretionary. Banner reporting 41 to 43% of total 41 to 43% of total retail value purchases, and import point of entry consisting of about 40% East Coast there. So ultimately here, we'll see how Dollar Tree is able to kind of navigate through and past some of the exposure that they do have. But JP Morgan, very, very positive on them this morning.
It's certainly a tough environment right now across the retail landscape. All right, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Now made from Daya Oat Cream Blend. Daya, dairy-free dairy.
For new businesses, Fiverr Freelancers is like a backbone. You can find anything. My name is Jimmy Valentin, and I'm the founder of Dribble Talents. I've seen musicians go through a lot, and this app will really help them. Working with Fiverr, it was pretty easy. All I did was log on. I went on search, I typed in app development. I found freelancers. I picked the one that would fit my budget, and the one that had great reviews. I got exactly what I wanted with just one click. Join Fiverr today and get something going.
Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Now the analysts upgrading the stock to outperform, saying that Hershey's moving a scenario. So let's take a look at the individual movers here this morning as we kick off the week. Hershey having a sweet day after Bernstein saying that the company sees market share and volume trends improving. Now the analysts upgrading the stock to outperform, saying that Hershey's innovation. Morgan Stanley saying it's optimistic about strong growth drivers for the company. Now the analysts there upgrading the stock to overweight, saying that they expect new customer acquisitions to boost revenue and also help margins.
Well, oil prices are lower as conflict in the Middle East escalates. 3 U.S. soldiers were killed. What can we expect the fallout to be for the U.S.? We've got our very own Rick Newman tracking this story. Rick, what do we know so far?
Well, this crosses a so-called red line regarding U.S. involvement in everything happening in the Middle East. There's this chorus of some Republicans on Capitol Hill saying President Biden needs to attack Iran directly. I would not necessarily expect that to happen. Biden, for what it's worth, has been pretty measured in his. I mean, we've seen a very incremental response. Ukraine, for example, where Biden gradually threatened global oil supplies, but there is a slippery slope problem here. I mean, United States keeps getting a little more involved, and it's not clear where this ends.
Yeah, certainly, his vow, President Biden vowing here to respond, and of course, talking about the question is how exactly that is going to happen, and if it is a structuring plan. For more on what the potential ripple effects mean for U.S. investors, we want to bring in Dennis Unkovic. He is a partner at Meyer Unkovic and Scott. Dennis, it's good to have you here. So when we We talk about the issues right now that China's property crisis. Continues to drag on. Put in context just the risk that.
Then the courts have said to the creditors, please, can you settle this? The answer is no. I think the judge said this morning, enough. The judge said this morning, enough is enough. And enough is enough. And so she said, we're going to have this company liquidated. Company liquidated. The big private real estate company in China, and it has similar problems to Evergrande. So the problem is, it isn't over, and it really may just be beginning.
The coincidence of timing as well here, Dennis. I mean, they're trying to stimulate the economy in China right now. So of that timing, this taking place and the liquor.
Then Country Garden, and then as they got in financial problems, it really got in financial problems. It really got worse. And so as the Chinese government, the Bank of China is saying, I'm going to the requirements to buy, the creditors can execute. But most of the assets, Brad, are located in China. The question is, will the courts in China enforce this order from
certainty? But do you think it is too little, too late?
Yes.
So then what?
I can give you a longer answer, but the Chinese, this is probably $1 trillion problem for the Chinese. And what Xi Jinping doesn't want to do, I think, is to say, okay, the government is going to bail out these private companies.
Obviously, a hot topic here heading into the 2024 election. If we do get a Biden-Trump rematch, how do you think Beijing is thinking about the outcome here in the U.S. and what that relationship could then mean for their economy and their markets here going forward?
5 years. And so I think they're worried about how a decreasing economy in China is going to affect their ability to do business around the world. And if I'm an investor and I'm looking at China, I'm going to be extremely cautious at this time about putting any more money or investments into China.
Further along that thought, if you're an investor and you're looking at China and to game out which companies are most impacted.
Goods to China now, and it goes across a broad range. They are directly affected by the health of the Chinese economy. Sole sourced out of China for anything. I think you need to really seriously look about an alternative source, not necessarily not doing business in China, but saying you're doing business in China.
Dennis, appreciate the time.
Thank you, Brad and Shauna.
Got it. Guys, coming up, all eyes on more economic data out this week. Economic? Well, out this week. Economic? Well, it's out this week. We're going to and Fed decision next.
Alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh with its now iconic 1984 commercial Super Bowl 18. The Macintosh stood out because it was the first Mac. After a run of CEOs, Jobs returned to Apple. The company purchased Next to use its operating system and named Jobs interim CEO in 1997. Apple introduced the iMac in 98, and the line would go on to sell millions of units. 3 years later, Apple debuted its first iPod, which could store from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over. Watch. Just 7 years later, Apple became the world's first
most controversial commercial of all time. Because plant-based cheese companies like us aren't supposed to show beef in an ad. But at Daiya, we believe everyone should be able to enjoy plant-based cheese, even on a beef burger. Enough controversy. Let's eat. 100% plant-based, even if you're not. Now made from Daiya Oat Cream Blend. Daiya, dairy-free dairy. Dairy-free dairy.
Hi, do you like bacon? Well, you'll love bacon soap. Congrats, you're pre-approved for every credit card.
Okay, wow.
Here's a box.
Oh, no. Oh, no, no, no. Give unwanted emails the finger with one tap unsubscribe from Yahoo Mail.
Oh, yeah. You're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time. From Yahoo, cancel on time. From Yahoo Mail.
Stocks muted this morning as investors brace for a big week ahead. Investors brace for a big week ahead, including January jobs numbers and the latest rate decision from the Fed. Let's bring in Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder. To discuss what you should be keeping an eye on. Great to have you here, back with us in studio here. So, of the top things investors should be watching over the course of this week, what is the key economic data point that is perhaps going to tip the scale one way or the other?
Right. For macro data, it has to be the PMIs. So these are surveys of managers. What are you up to? What are you feeling? Than full-time jobs, and that's been a pretty clear shift. Again, you see managers keeping people employed, but keeping a lot of variability in how they are employed, and then a leading indicator of employment, one that makes a lot of sense, is temporary employment. Is it strong or is it weak? And that's down 10%. The level has fallen 10%. Again, that's pretty much recessionary. So that's the bad. I'll give you the good. Education and health. These two big sectors of our economy, and government to a degree, really steady as you go. Strong, really steady as you go. Strong jobs growth in 2023. I think we got 4% jobs growth in education and health. So really solid anchor underneath jobs growth. And then, of course, the amount of people who are out there, there's still some tightness in the labor market. A lot of backwash from immigration going down, legal immigration, and people moving around after COVID.
You know, it's particularly interesting when you're out at brunch with friends on a Saturday. And the tech layoffs or any of the waves of layoffs. Layoffs that we've seen come forward, they make it to the conversation. and we're talking about economics at that point.
Yeah.
But we're also talking about whether or not that show
going on in Red Sea. But then also, we're seeing other starting to perk up. Remember, we've had this huge downturn globally. And at some point that runs its course and starts bottoming out. It looks like on the price side that maybe what's in store for us in 2024, supply chain issues are just adding on top of that. And the U.S. can't disconnect from that. That global inflation cycle. We're going to be part of it too. So I think it starts to limit the amount of leeway that the Fed has in 2024, and that's right. Expectations are, hey, we're kind of mission accomplished here. That's right. Expectations are, hey, we're kind of mission accomplished here.
Yeah, we see a lot of that optimism priced into the market as well. Lakshman, always great to have you. Thanks so much for coming on set with us here today.
Thank you so much.
All right, let's take a look at some of the moves that we are seeing in crypto this morning because
in the leadership position there. To be fair, there's already a Bitcoin ETF in Cboe markets. That offering has been there for a while. But the main exchange is Australian Securities Exchange. That's the ASX, and there appear to be a couple of different Bitcoin ETF spot ones in the pipeline. And basically, this is just because other countries around the world don't want to be left behind in the future. You look back, how come you didn't have Bitcoin exposure? It's up 1,000,000%, or it's down 1,000,000%. No, you take a look around the world. Hong Kong is a potential jurisdiction. It's right by China. By the way, Bitcoin is still illegal in China, but Hong Kong is a major distribution center for financial finances. Singapore also mentioned, and then there's the UAE. The biggest problem with the UAE is there's just not a lot of interest there. But enough about that. Let's get to the underlying, the source here, and that would be Bitcoin itself. And we'll do some technical analysis, down 0.8% over.
Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 10,000 blocks are mined. We can calculate the date fairly precise. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Needed because there's only so much Bitcoin available. More crypto stakeholders, and we'll be.
Oh no. Oh no, no, no. Give unwanted emails the finger with one tap unsubscribe from Yahoo Mail.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Over 20,000 tech workers have lost their jobs so far this year. That's according to the latest data out from layoffs.fyi. Now, the latest cuts coming from iRobot here today, just this morning, announcing that it's going to cut about 31% of its staff. And Glassdoor data showing a recent spike in layoffs is hurting employee confidence, that falling to its lowest level since (2016). So where does the labor market stand? We want to bring in Daniel Zhao. He's Glassdoor's chief economist. Daniel, it's great to have you back here in studio with us here. So ahead of the jobs report that we're going to get on Friday, the last several reports have really proven the fact, or really signaled that the labor market has stayed resilient, yet we keep getting these types of headlines, specifically within the tech sector, that they're losing jobs and they're continuing to lay off workers. What's going on? What's the reason for that?
Well, so I think it's interesting because we say that the job market has been resilient over the last year, and that's absolutely true, but it definitely has slowed. The hiring rate has come down pretty significantly, and then even though measured layoffs are still fairly low, clearly are still fairly low. Clearly, it is something that workers are concerned about. That's why we see employee confidence coming down, and that's why people are still concerned, even though the hard data is showing that the job market is still relatively stable.
And so for those who are now in the midst or caught up in these layoffs now, are there...
Hiring has really come down, even though layoffs haven't really increased as much as the headlines might imply. And I think that's actually creating a bit of a lock-in. You know, we talk about lock-in in the mortgage or in the housing sector rather, but for the job market, voluntary turnover as people quit less. And there are a lot of people who are kind of hunkering down and in a bit of a holding.
We're getting headlines out. It seemed like that conversation died down about this push in the return to office, but Bank of America, one of the latest from Wall Street, really cracking down on the need that employees need to come back a certain number of days a week. What do you think that's going to do to the jobs market, to the jobs picture here in the next few months?
The balance of power has shifted back towards employers. That means that they can more aggressively pursue these return to office plans. And quite frankly, like it's still up in the air how exactly that's going to turn out, whether employees are really going to acquiesce to this or employers are going to have to push even harder.
And so as we're staring down
that we are going to see some softening. We are going to see that still probably the picture we're going to get in 2024. I don't think we're going to see really this latest wave of layoffs really affect the numbers very much. But I think
when we talk about so many of these headlines involving tech companies here, is that going to be the theme?
Sort of thing. And I think overall it's going to show that 2023 was maybe a little bit cooler than we had originally thought. Yeah. For layoffs, I think we are still going to see a lot of tech. The theme for what, right?
The layoffs, yeah.
Yeah. For layoffs, I think we are still going to see a lot of tech companies try to cut. I think that a lot of these AI technologies are very new. They're not really proven, and so we are seeing some examples examples of companies investing and experimenting in these technologies. But I think a lot of companies are still hesitant to really pull the trigger and say, we are going to fully replace this job with AI. That being said, the advances in that space have been very, very rapid, and so I wouldn't be surprised.
Phones and iPads to Macs, Apple Watches, and AirPods, Apple's products and the numbers prove it. The company generated more than $394 billion, and the numbers prove it. The company generated more than $394 billion. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple in Los Altos, California in 1976. That same year, Wozniak built the company's first product, the Apple I. Apple debuted the Macintosh. Apple debuted the Macintosh with its now iconic iconic 1984 commercial during Super Bowl 18. The Macintosh stood out because it was the first mass-market personal computer to feature a graphical user interface and mouse product yet, the Vision Pro. A mixed reality headset, the Vision Pro is scheduled to launch.
Do you like bacon? Well, you'll love bacon soap. Congrats. You're pre-approved for every credit card.
Okay, wow.
Here's a box.
Oh, no. Oh, no, no, no. Give unwanted emails the finger with one-tap unsubscribe from Yahoo Mail.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free child alerts to the rescue, so you cancel on time. From Yahoo! Cancel on time. From Yahoo Mail.
Adjusted earnings estimates by about 5%, which is also 6% below Wall Street consensus expectations. And he cited several risks here as we head deeper into 2024. One of those being the fact that M&A, a lot of executive commentary as of late, seems to have thrown cold water on the idea. Also, the fact that we're entering an election year really doesn't necessarily mean that we'll see much of anything. There doesn't seem to be a big rush on the side of any of these big companies, Paramount included, to really make some sort of a deal here. Also, in terms of the content strategy, that's something else that Keyhall is looking at very closely, because management is really at a crossroads when it comes to balancing some of those original titles, maintaining that streaming exclusivity for Max, while also licensing content to competitors. He argues that there's a lot of opportunity there to potentially license some of those marquee titles like The Sopranos. And Friends to a Netflix or even a Paramount. I think a lot of these companies would pay big bucks to have those types of shows on their platform, but at the same time, if they do that, that's going to hurt their engagement down the line. So even though the HBO slate looks pretty strong in 2024, there's these overhanging risks and really uncertainties about their 2024 growth initiatives that he's a bit concerned about.
Ali, while we have you, we also just got a report from Nielsen that Americans streamed a significant amount of TV last year. Just how significant?
Pretty significant, especially if you were a fan of Suits, Suits. Led the top 10.
I was shocked by that.
Entertainment industry. The company generated over $32 billion. Over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the ticker, takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix. In Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while
Well, 2023 was the hottest year on record Well, 2023 was the hottest year on record by far, and scientists say that we will continue to see record-breaking years as the planet
heat and climate change, and we discussed CCUS, we discussed Partana as a solution to carbon absorption and removal. And so we're one of the players, one of the solutions in the future here that can add to changing the way we build in the world for good.
When you talk about the material and the difference for Partana and what you're bringing to the market, naturally, a lot of the attention for Partana and what you're bringing to the market, naturally, a lot of the attention will go towards, okay, well, what's this going to cost us? How much different is the cost between the existing concrete that people have become accustomed to that creates an emissions problem versus what Partana is bringing to the market?
So I will give you comfort in the area of we currently have customers. So those out there that want to make the change from the traditional materials that are being used to more nature positive materials, they're making decisions around decisions around purchasing our materials, which is great. Depending on the product, there's a large scale and spectrum from high-end products all the way down to affordable housing. So where we are in the Bahamas right now, under the leadership of the Prime Minister of the Bahamas, in the government of Bahamas, we're building in the government of Bahamas me to be an innovator in the area of team building and the area of bringing the brightest minds in the world. And when I point about the science around our Partana, we have some of the greatest scientists in the world that worked on this for 6 years. They've been innovating concrete for decades. This happens to be their greatest contribution to the world right now, bringing this material to the world. Excited that their work will be seen from the lab to actual commercialization, which is usually the biggest challenge. We talk about the financing of something like that, the scaling of something. Something like that. And then also the challenges around getting people to adopt something like that. I would challenge people and comfort people with the news that when you are verified stringently globally by the verifying bodies, ASTMs, interlockings, any international national standard, I promise you that we would not be allowed to to build structurally anywhere in the world if it wasn't approved by the architects and the engineers and the technical folks that make sure that when a person walks into a building, it is safe for them to be in. We've passed all of those standards. We now are moving to commercialization, and we're finding the partners that want to innovate in the world, that want to make these changes and bring these materials to the front line of climate change, right? And so it takes the courage that you would say to get up every day. The Bahamas, who took the courage and took an innovative step to invite us to come to the Bahamas and work from the front line of climate change, right? And so it takes the courage that you would say to get up every day play the game of climate technology. Now instead of basketball, take the wins and the losses and completely search out on a daily basis.
Hearing from Microsoft, Amazon, Apple, Google, Meta, market value. Certainly you want to keep these names on your radar this week. That's all for us. Akiko and Rochelle have you for the next hour. We'll see you tomorrow.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Cancel on time from Yahoo Mail.
Alongside Akiko Fujita, here's what we're watching this morning. Looking at shares of Hong Kong listed Evergrande,
Speak with the CEO on the floor of the New York Stock Exchange up ahead.
That's right. Plus, of course, a big week for tech. What investors should expect week for tech. What investors should expect as more Mag 7 giants get set to report results.
But first, let's take a look this week with the big tech companies certainly going to be in focus there. Also, the Fed meeting, Fed starting its two-day meeting tomorrow. And we are taking a look at Treasury yields on the back of that as investors await that Fed decision come Wednesday. Take a look at where things are, all pulling back from the longer end to the shorter end here. The 5-year yield at 4%, the 30-year yield at 4.35, and the benchmark 10-year at 4.11. We are beginning this hour, though, with a developing story in Asia. Hong Kong court ordering one of China's largest real estate developers Evergrande to liquidate. That sent its stock plunging 5% of the world's second largest economy. And Rochelle, of course, the immediate question here is whether, in fact, a mainland Chinese court will accept the ruling that came through from the Hong Kong in the world. In many ways, Evergrande's kind of become the poster child of a deepening crisis in the property sector there. The question is this a one-off of a company?
Now, at least based on the Hong Kong court decision, not seeing that court decision. Not seeing that. We know that President Xi wanted to pull back on a lot of the speculative buying that led to the ballooning of a lot of this debt for some of these real estate developers. So it's interesting because you're balancing not coming in to rescue at least Evergrande with also some of these other policies.
Here, and then, of course, the head of Evergrande, the founder, was placed under police surveillance, which is something that we have seen in China when the government really tries to crack down what they consider to be more bad actors in the sector. So you mentioned Country Garden. They were sort of seen as more the responsible players. There were real concerns when they defaulted on their debt as well. So obviously the property sector is something that's certainly going to stay of course, any kind of contagion effect coming.
To retaliate, saying in a statement that those responsible will be held to account. As for Iran, the nation's foreign minister is distancing himself from the attacks, saying that accusations of Iranian involvement are, quote, baseless. With tensions flaring, what can we expect the fallout to be for the oil market? Joining us now Academy CEO and Aham Kamel, Eurasia Group
in the region. I think more likely than not, the Biden administration is creating a calibrated military response that very loud in terms of targeting militias in Iran. That might impact inflation expectations and over the long term, even Biden's own position. Domestically. So more likely than not, we're looking at a contained sort of conflict, with a higher risk. Probably going to be careful.
Agree. I do think even now with oil prices down today, there's probably about $3 to $4 of risk premium already built in because of tensions in the Middle East, especially with what happened over the weekend. But you the action today, given everything that's going on, given the tensions in the Middle East, that could disrupt the marketplace. But I really don't think so. So to me, as a trader, I actually love this extra volatility. And though much of the marketplace is looking at this as a buy the dip very quickly, you can always have a big pop if, God forbid, something, really tragic. With futures, you always need to use a stop. But I
at a very comfortable price range. I think for the Saudis, OPEC plus in general, any range of oil prices, and sort of the 80s is completely acceptable. There's not like to be a big reaction to put additional barrels on the market in the current environment. Risks as they are, the Saudis will be cautious in terms of putting additional or taking barrels or putting additional barrels on the market. Stable status quo works. Tendency to create their own dynamics. Where we are today is not a very comfortable place in terms of risks in general. I do expect additional sort of military strikes and confrontation.
And Iran. It feels like with every strike, you're that have been killed as a result. Within the
direct strikes on American interests. on American soldiers. That is what is one of those scenarios, as you guys proved right now. We all hope it doesn't happen, right? We all hope that the supply doesn't get affected because of an escalation. It certainly is an escalation possibility. It is not a probability. It is a possibility. As you just said, it's going to be a volatile next couple of weeks here. Escalation. I think you really have to look for crude to move lower. It's just that it's all about the demand right now, unless there's a big escalation.
So, Scott, a $3 to $4 risk premium. Already baked into oil prices. In the meantime, though, if you're medium term, what are we talking about? Mid 70s, low
precipitous pop, but I think that precipitous pop but I think that 70, 72 area, if the escalation does not happen, that's where we're going.
Well, I appreciate both of you for joining us with your insights and this important context as well. Scott Bauer and Aham Kamel, thank you so much.
Thank you.
All right, time now for today's trending ticker. We're watching the big tech stocks. Amazon, you have cloud in relation to AI as well that I'll be looking at. £100 gorilla entering the room, and he's looking at its active users of the room.
Coming to a halt here, essentially coming to a halt here. Essentially not going through because of regulatory concerns on that front. Obvious reasons when you think about the big tech rally that we have seen. Microsoft has said that's just the beginning in terms of the user experience. So we'll be looking for some hints on what additional measures that are likely and what additional features that Microsoft is hinting at. And of course, the bottom line here, investors are going to be asking, well, what does that revenue look? Going to be asking, well, what does that revenue look like that's coming in from AI? So certainly a lot going across in Microsoft, as well as other mega.
We think of market cap and the potential for it to overtake it. But when I think of Apple, you think it has that nice secure moat. But then we saw that slowdown in demand. We saw people not buying as many devices. And as we've been talking about, we have that upgrade cycle that's also coming up, which could also be an additional boon for Microsoft as well. So interesting positioning here. There'll definitely be an earnings call. I'll be excited to listen in.
Yeah, I mean, you mentioned Apple reporting later this week. I mean, there's still questions about what the Gen in-house, but we'll be looking for some additional hints on that front as well. Well, coming up, we'll head to the floor of the New York Stock Exchange for an interview with the CEO of Flutter after its U.S. debut. That is coming up on the other side of the break. We'll be right back.
Do you like bacon? Well, you'll love bacon soap. Congrats, you're pre-approved for every credit card.
Okay, wow.
Here's a box.
Oh no. Oh no, no, no. Give unwanted emails the finger with one tap unsubscribe from your finger. With one tap unsubscribe from Yahoo Mail.
Well, you'll love bacon soap. Congrats, you're pre-approved for every credit card.
Okay, wow.
Here's a box.
Oh no. Oh no, no, no. Give unwanted emails the finger with one tap unsubscribe from Yahoo Mail.
Hi. Do you like bacon? Well, you'll love bacon soap. Congrats, you're pre-approved for every credit card.
Okay, wow.
Here's a box.
Oh no. Oh no, no, no. Give unwanted emails the finger with one tap unsubscribe from Yahoo Mail.
Welcome back to Yahoo Finance Live. We are here on the floor of the New York Stock Exchange, and standing with me is Flutter Entertainment CEO Peter Jackson. Flutter, I guess, why now? Why come to market now?
We've been really excited to come and list our business here on the New York Stock Exchange. It's the world's biggest capital market. We're the world's biggest sports betting and gaming business, and we to get our secondary listing accepted, but we're delighted we're here and we're very there. We are a fast-growing business. If you look at our revenue growth last year, we're up 25%, and we get the benefit here with Flutter of owning FanDuel, but also all of our international businesses, which are growing between 5 and 10% as well. The $40 billion figure that you referenced, we simply looked at the number of states that we anticipate licensing, look at the penetration rates that we expect to get to in comparison with Australia and other markets. And we look at the average bet size that and that's where we get to the $40 billion. I suspect
all 50 states and gets as big as it could be.
there are clearly going to be some states which would be holdouts, right? So we don't expect Utah to pass legislation. But, when we look at the three big states between Florida, Texas, and California, we'd expect that we'll be operational in at least one or two of those states in time. Look, there's plenty for us to go after. We're in 45% of the population here in the US can already avail of the FanDuel sportsbook, and there are more states that we think will come on stream in time.
And I'm curious, Peter, when you think about competition in the space, one of the big discussions entering this football season here in the fall was ESPN getting into betting for the first time, right? And we had Fanatics getting into betting. So some new players, after you sort of work so hard dominate the market share with DraftKings. How's that impacting your business?
The same game parlay that people love and are really embracing in American football and also in basketball, something that we pioneered and we're well ahead of the competitors, and that's what's really important for us in this market.
Same game parlay is going into one game and betting on multiple outcomes, right? Betting on someone to score a touchdown and maybe betting on their team to win and combining those bets into one.
Absolutely.
How's that helped you as a business? Because I'd imagine that might be a higher margin part of the business.
Well, it's a very complicated thing to pull off. And kudos to our team in Australia who solved the math involved in those outcomes. And in Q4, sports results went against us. We to our customers, because the sports results went against us. So these to our customers, because the sports results went against us. So these parlays work sometimes for us and sometimes for the customers.
How do you manage that as a business when you have that much? And Peter, it is the day after the NFC and AFC championship games, so I have to ask you about the Super Bowl coming up in 2 weeks. We have Chiefs and we have 49ers. I'm curious, just for you as a business, is this still kind of the biggest weekend for the sports betting industry in the U.S., or is that starting to industry in the U.S., or is that starting to shift as the market matures?
It's interesting. If I look at the amount of bets that we had on those two games, yesterday, if I just take the 49ers game, that was the single biggest game that we've had since the Super Bowl last year. So we'll sure the Super Bowl will break records for us in a couple of weeks' time. We're rooting for our customers and try and deliver them a brilliant experience at the Super Bowl.
Is that your way of saying you don't have a pick for us?
I'm not going to give you a pick. I don't want to get caught out doing that, but look, we'll be very excited. There'll be 600 markets available for our customers to select from. The big question, though, for the Super Bowl is, will the Gronk make it or will he miss? That's what we don't know this year.
We'll be watching for that FanDuel ad during the Super Bowl with Gronk.
Daily necessity for millions, and the numbers prove it. The company generated more than $394 billion in revenue in 2020. Alone. But how were they able to achieve such staggering success? Beyond the Ticker charts its path to becoming a tech giant. Steve Jobs and Steve Wozniak founded Apple Los Altos, California in 1976. That same year, Wozniak Computer Company. In 1991, Apple's Computer Company. In 1991, Apple introduced the PowerBook line, which set the standard for most modern laptops. In 1996, after a run of CEOs, Jobs returned to Apple. The company purchased Next, system and named Jobs interim CEO in 1990. Revolutionary device, the iPhone helped create an entire business model around apps and the App Store. Jobs suffered from pancreatic cancer towards the end of his second term as CEO. He resigned from the company just before his death, and Tim Cook took over as CEO in 2011. In 2015, Apple took the wraps off of its first new device since Cook took over as head of Apple, the Apple Watch. Just 7 years later, Apple became the world's first publicly traded company to reach a market cap of $3 trillion. And in June 2023, the company unveiled its most ambitious in early 2024.
Oh no. Oh no, no, no. Give unwanted emails the finger with one-tap unsubscribe from Yahoo Mail.
Hi, do you like bacon? Well, you'll love bacon soap. Congrats, you're pre-approved for every credit card.
Okay, wow.
Here's a box.
Oh no. Oh no, no, no. Give unwanted emails the no. Give unwanted emails the finger with one-tap unsubscribe from Yahoo Mail. Yahoo Mail.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time. From Yahoo, cancel on time. From Yahoo Mail.
Well, stocks a bit muted this morning as investors brace for a big week ahead, including January jobs numbers and the latest policy decision from the Fed. Let's bring in Marvin Lowe, State Street Senior Global Macro Strategist. Marvin, good to talk to you this morning. Taking a look at where Treasury yields are tracking today. We're seeing a bit of a pullback broadly from the longer to the shorter end. As you look ahead to Decision Day Wednesday, how are you positioning your portfolio?
Yeah, I mean, it's really a function of whether or not we're going to get anything significant coming out of the Fed. We have been increasingly in a range-bound environment, if you will, somewhere between 4 and 4.25. As we get closer, it gets kind of narrow in there. You know, I think I'm positioning basically around the fact that we're going to stay in that range, and that commentary that the Fed is going to, you know, be cutting at some point in the next several months remains in place.
And of course, a lot of people wondering when we're going to see that. And of course, a lot of people wondering when we're going to see that first rate cut. And obviously, depending on the circumstances as to why the Fed would also need to cut as well, despite getting some political pressure, as we saw earlier today from Elizabeth Warren. What is your take on what makes sense in terms of the first rate cut? What sort of circumstances?
Yeah, I mean, you know, so far it does look like the economy's holding in. Certainly, we've got better inflation data that makes an argument that the Fed should be cutting earlier. But at the same time, we've got consumer strength, we've got employment strength, and what we saw in last week's growth numbers, the GDP numbers, it shows that there's that momentum that's carrying itself into the beginning of this year. To me, I'd like to see how all these chips fall so that we can assure ourselves.
We mentioned the Fed meeting as well as jobs report. We've also got a slew of earnings coming down this week from those mega cap tech names. Given the run up that we have seen in these names, is there a situation where you would see yourself adding exposure depending on what comes down in earnings? Just when you think about just how high the valuations are right now.
Yeah, I mean, that's the biggest challenge, certainly. The valuations make it hard to add. Kind of having said that, I do think you wind up in an environment where if you're maybe more tactical in trading and you can ultimately move around and trade around some of the volatility that might come around, I think it still is supportive for overall risk because we're, again, going to be in an environment where we think the next move from the Fed is on those real mega caps. And we're going to get a sense this week as to whether or not it's justified.
And Marvin, of course, investors with that one eye on earnings and really begging for some clarity from the Fed as well. But one thing, we talk about that headline inflation number. But what about that headline inflation number? But what about the balance sheets, things rolling off the balance to that?
Yeah, 100% that then.
But the bar keeps getting higher for CEO Lakshmi. Narasimhan, still in the early innings of his leadership and a high-profile reinvention strategy. Here are the 3 key areas you'll want to keep an eye on when Q1 numbers hit. Number 1, innovation. The recession that was definitely going to happen did not. But the risks of consumer belt-tightening never disappear. Record sales in the fiscal fourth quarter were no doubt padded by the early appearance of the most popular seasonal drink on the menu, as such finances coverage on Starbucks' first quarter earnings report.
Well, you'll love bacon soap. Congrats, you're pre-approved for every credit card. Congrats, you're pre-approved for every credit card.
Okay, wow.
Here's a box.
Okay, wow.
Here's a box.
Oh no. Oh no, no, no. Give unwanted emails the finger with one tap unsubscribe from Yahoo Mail.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time. From Yahoo, cancel on time. From Yahoo Mail.
The gig economy is on the up and up. More than a third of workers performing freelance work in 2023. That's according to an Upwork report. And gig workers contributed more than $1.2 trillion billion to the U.S. economy last year. Rochelle, I guess the key here is that they performed freelance work. So it doesn't mean they were freelancing full-time, but the number that stood out to me in this report, 23% of all freelancers, 14.7 million professionals created influencer content like live stream services, social media videos. So the question I have is it just that there's more? The question I have is it just that there's more platforms out there that allow you to freelance, or is it about flexibility?
I mean, you figure it's got to be about a bit of both, and also trying to keep up with the cost of living as well. Because as you mentioned, it might not be that these people are doing freelance work as their permanent gigs. It could be like a little bit of something on the side to perhaps like supplement their salaries. I thought it was interesting that they contributed $1.27 trillion. Makes you wonder though, how much of this is being reflected in the jobs numbers? I think during COVID it was easier to hide. If you had a second or third job when you were working remotely and nobody knew. But as people are returning to the office, it's getting a little bit more difficult to balance these things. But I thought it was interesting that you're also seeing a lot of these well-paying jobs they're not the traditional ones that we all thought of growing up. You mentioned the influencer economy. Even on Indeed.com's top jobs, their top job that they have on there that doesn't require a degree alone, $1,000. So these are things, and most of the phrasing was either hybrid or remote. So there is a lot more flexibility. Now, and I mean, good. People are taking advantage of it to
union or have a safe workplace. So all of these laws protect employees and not independent contractors. And that is why this new rule from the Biden administration is so important, because a lot of corporations have kind of taken advantage of using a model and calling people independent contractors, sort of engaging in the fiction that they're running a totally independent business, when in fact they are employees. They're working under a lot of control by the business. They're doing work that is, not really running their own business, but is actually business, but is actually almost all the terms and conditions, are dictated by that large corporation. And so that is what this Biden rule is hoping to cut down on, and hoping to prevent, and to make sure that workers get all of those protections that the laws provide. And in relation to flexibility, often people, the the two gig companies that were hiring workers. It was astonishing to me when I learned about it. They were hiring workers in restaurants, doing jobs like prep cook and busboys and dishwashers, hiring them as independent contractors instead of as employees. And again, if you go back to what these laws, what this means, the tips people have left for them. They don't have a right to a safe workplace. They don't have a legal right to get the tips people have left for them. They don't have a right to a safe workplace. These are very serious deprivations of people's rights. And the notion that a dishwasher in a restaurant is running their own small business is kind of, ludicrous on its face. And to me, and why I was inspired to write the op-ed in the New York Times is that, this sort of shows the spread of this model to, far beyond drivers or delivery workers or, much higher paid, knowledge and creative workers to really, really areas where we've never seen it before: restaurants, warehouses. I found websites doing some Googling where there were healthcare apps that were hiring nurses, hospital janitors. There's an education app that bills itself as being like DoorDash, except you get to work with kids spread throughout the economy. And it's really, really concerning. When you think about the fact that it means that workers, by doing this, companies are trying to ensure they don't have to pay minimum wage or, comply with the laws that every other employer has to follow, including our tax laws as well.
So Terry, it sounds like this sort of using this sort of veil of flexibility to cover not having to really pay and protect some of these workers. I do want to ask you about some of the pushback that you lose earning opportunities. There'd be confusion on the rules, I guess, depending on which state or vicinity that you're in, and that means lots of lawsuits and all of that. Our labor and employment laws are really, a bare minimum floor protection for people. The notion that businesses need to be excused from the minimum wage law or from payroll taxes or from unemployment insurance as a condition of operating, that's just, as a society, agree that workers do deserve some basic minimum level of protection. And frankly, a lot of, most companies and corporations throughout US history and presently in the economy manage to operate using employees and following those laws and paying their taxes. And it is not the only way or rule of nature that this is the only way for businesses to flourish and prosper and to be profitable.
Terry Gerstein, NYU Wagner Labor Initiative Director. I appreciate you joining us today. Thanks so much.
Thank you so much.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Hey, thanks for tuning in. This has been the Living Legacy Live channel, and I want to thank you for joining me this morning. And in the afternoon session, we will go through our lesson that will be taught by Oliver, and then we'll go into the psychology part, and we may visit our friends over at Trader TV Live. So definitely. All right. We are going to take our lunch now. We've been studying these charts